Right, everybody, welcome to today's webinar. It's Ed here. God, there are people coming in from all over the place. Some in China, some in Spain, Portugal. I've seen at least 2 people from Cambridge, Poland. Welcome, everybody. Fantastic to have you on the webinar today. This will be hopefully really quite fun. This is all about screening the stock market. I framed it as for growth and income winners, but I'll be covering a lot more ground than that. From Glasgow, I've just been watching the rugby and it's quite hard to tear myself away, being born in Dundee myself. Welcome everybody. Look, let me just crack straight on with the slides. Really great you're all here today. Everyone here is a subscriber. So, and everybody here, there's lots of different experience in the market from all of you. Yes, you should have sound. Let me know if you can hear me. I've got the mic on and I'm hoping you can. So I'm obviously rattling on and I'm presuming many of you would have told me. If you haven't got sound, do try refreshing. Sometimes the internet can cause a few issues. Yeah, great. No, Abu Dhabi, Harrogate, awesomeness. Okay, so I'm going to just share my slides and show you what we're up to. I'm going to be bouncing a little bit between slides and the website through this web. Forfar, someone's in from Forfar. I'm actually from Brecon. I grew up in Brecon. Might not sound like it, ruined by an English education. And Sydney, where my wife is from. So there you go. A few of you having some sound problems. I'll check with the staff in the office to see if they're having any issues too. I suggest refreshing it if you can, but I'll just try turning my mic on and off again. Okay, I'm going to crack straight on. Right, this webinar is for 2 groups of people. I did a survey. Many of you have very kindly filled out the survey before I did the webinar. And about 30% of you have not ever created a stock screen before. 70% of you have. So we've got a real range of experience here in the market and with stock screening. And I don't want to exclude anybody. So if you're a developing investor and you want to find a more effective investment idea source, this webinar is right for you. But if you're a really experienced investor and you've been a subscriber for many years, and you're just looking to find better ideas or get more familiar with the advanced screening that we've got on the site, this is for you as well. So please do bear that in mind. I'm structuring the webinar so that everybody gets the most out of it, and I'll explain how I'm structuring it in a minute. But if you're an international investor, if you are an Australian subscriber, or you're a British investor looking for international stocks, it's also for you. Someone's from Oxford as well. Great to see you. Let us know. We're in Oxford as well. So if you want to meet us or meet the team, just get in touch and you can come visit the office. Yes, somebody's asked, will the presentation be available for download after? Yes, it will be. We're also recording it. So if you do have to pop out, you can't go through the whole thing. It will be made available to you afterwards. So don't worry there. If I'm looking this way, that means I'm looking at the slides. If I'm looking this way, it means I'm looking at all of your questions. So I can miss questions in the beginning, but I will try and check in every now and then and answer a few ad hoc. But there will be a session at the end to go very much into Q&A. Okay, so what are we going to be talking about? We're going to be talking about the stock screener on Stockopedia. We have a lot of pre-rolled stock screens, which are fantastic. If you're getting to know this methodology of finding investment ideas, I'll be talking a little bit about all our pre-rolled Guru screens and the Stockopedia screens based on the StockRanks to begin with. And then I'll also be going into our custom screening interface to show you how to build up your own screen rules. And I'll be going to quite a lot of advanced techniques too. So there's a lot for everybody here. Now I will be using the new version of the Stockopedia site. It's one of the real standout features is the screener. I can't use, if you are on the old version of the Stockopedia site, and I know a lot of you are, and you want to take advantage of these new features, please do switch over. Go to stockopedia.com/opt-in. You can always opt out and go back to the old site if you want and you find it unfamiliar. But a lot of the things that I'm going to be showing you will only be available in the new site. So please do go check it out. Go to /optin. I would be good if, Sam, if you're listening, if you can put that link at the top of the chat box so everybody knows where it is. Now, on the agenda today, as I said, I'm going to structure this so that people who are more novice get the most value up front. And as we go through it, I'll build on it. I'll go deeper into it as it goes on. So if you're finding it gets too complex, feel free to drop out at the point that feels right for you. As you get more confidence in the systems and in the approach, you can come back, watch the replay, etc., etc. So I'm going to start with a little bit of background on screening, what it's all about, and some simple screening for novices, especially using the StockRanks and the Guru screens. And then I'm going to go into a bit more of a deep dive on one of the Guru screens, which is the Zulu Principle by Jim Slater. Which is a great strategy. Actually, I've got lots of books handy here, which I'll be talking about later. But I'm going to show you how to learn from that strategy and understand why it's such a good strategy for finding reasonably priced growth shares. I'm then going to go and talk about customizing screens for better results. And I'm going to go quite deep into the Stockopedia interface to show you how to do that. I've also got a cookbook of financial ratios and I know I said on the landing page that this is for people who don't know much about financial ratios. Well, obviously, as you get screening, you're going to know more and more and more about financial ratios. And what I've done is I put a little cookbook together with about 10 slides with my favorite ratios and some suggestions for where to set your rules. And I'm going to distribute that as we come to that section. So basically, it's like a cookbook. You can put those rules together and you're going to find really good results. I'm then going to go and look a little bit more about advanced rule types, talk a little bit about our data, explain how you can customize the displays, and then I'm going to open it up for Q&A. I mean, I anticipate it's going to take us an hour and a half, maybe. I could still be rattling on after 2 hours, but remember, you can stay as long as you want, and as long as you're getting value, please do stick around. So cracking on next up. Right, this is me. I know you probably all know who I am, Ed Croft. I'm the founder of Stockopedia. I got into this. I love stock screening, and actually I have some news. The reason I got into this was because of Jim Slater, who is sadly no longer with us. Jim Slater wrote a book called The Zulu Principle, and this isn't actually The Zulu Principle. I appear to have lost that book, but this one's called Beyond the Zulu Principle. And Slater created a company which did stock screening, and it was called Company Refs. I have some news that we've actually managed to acquire Company Refs in tandem with Slater Investments. We'll be doing an announcement later in the week about this, but I'm hoping that we can help people that were previously subscribers there. I'm going to go into the Zulu Principle in a little while. Another thing which is good news, Robbie Burns has written a new book called The Naked Trader. Robbie, I was at his book launch in London on Saturday night with Ben Hobson, who works with me. And Robbie's written a 5th edition of his book, The Naked Trader. And on one of the pages, he has written about his favorite financial websites. Now, this is a bestseller in the UK. It's a really great book for all investors. Really talks about trading and investing in plain speaking. And he said his main place is number 1, Stockopedia. So Robbie, the first time ever, he suddenly dedicated a whole section of his book to Stockopedia. And, I'm not getting any commission on selling his books, but it's quite good to see we're part of the furniture now. He talks about the screens, he talks about the stock reports, he talks about the stock ranks, and how he's woven it into his own process. He talks a lot about it in his own seminars and webinars. And his book launch on Saturday was a really fun event. So it was good to be there. Lots of very funny jokes, a couple of comedians. But anyway, that's Robbie. Do get a copy if you find that interesting. Right, back to my slides. Anyway, looking at, next. Quick disclaimer, always have to do this. We are not an investment advisory. We provide fantastic data and metrics, which we try and back up with the history and with all the kind of performance history of how these stats work. And we provide all the education around it. But we don't tip stocks. We're not a financial advisor. Everybody using Stockopedia is a self-directed investor. And I'm really here to help everybody make better investment decisions on their own. We have that philosophy of, teaching a man or a woman to fish rather than giving them a fish. So just be aware, stocks go up and down, and all the usual disclaimers. So if you do need an advisor, please do get an advisor. So cracking on. Yeah, thanks, Parallax. So you were at a seminar last week. I met a few people who were at Robbie's seminar recently. He is very, very, he's a great champion. He's a great champion of the private investor generally, and he's a bit of a one of a kind. Why stock screen at all? Now, as I said, 30% of you are novices. I'm going to start, with the more straightforward ideas, and we're going to get onto the much deeper stuff in a little while. So very quickly, David Stevenson. I know David. He is a fantastic writer and investor. He writes the Adventurous Investor column at the FT. And back in actually 2013, he wrote this article in it was very much about Stockopedia. But he said, how might an ordinary investor who does his or her own stock picking unearth a gem like Dart Group? Most likely using online systems such as the ones developed by Stockopedia, stock screening systems really, really matter. Now, interestingly, he wrote this after Dart Group had doubled. And the piece was really talking about how you could find it and how you would have found it on Stockopedia. Well, very, very interestingly, Dart Group is the only stock that he's mentioned that he selected from Stockopedia. And he did this way back in 2013. And as you can see, it's gone from, and that was after it had already doubled, and it's now gone up another 600%. Now, obviously, not every stock you screen is going to do as well as that, but I think that's pretty interesting and shows some of the benefits, because he had found that, you weren't going to find that being discussed about online. Now more and more people know about Dart Group, but it's already had a huge run. So, it's important to stress that the very popular stock idea sources often are full of the crowd, press tips, broker recommendations, bulletin boards, conferences. People get their ideas from friends online, and these are quite unreliable stock idea sources, I have to say. We've done, and it's a hobby of mine to study these, and we've actually did a study over the summer of the top share tips of the year from multiple national newspapers and investment mags. The FTSE All Share, which is in black here, is the black line, and you can see that the tips of the year from the Guardian have done very, very badly every year. We've taken the tips every single year and created a study. This was created by my one of my interns from Oxford University. The Times and the Guardian both underperformed. Investors Chronicle did outperform, not by much. Shares Mag underperformed, which is now owned by AJ Bell. But the point is, share tips are quite unreliable. Now, stock screening gives you a lot more ability to find shares that actually are more exposed to what I call factors, which I'll be explaining in a minute. So really, using a stock screener is about accelerating having an accelerated idea source that speeds up the research and discovery process, but helps you find investment ideas before the crowd has ever even heard of them. On that point, Games Workshop, which has become very popular on investment bulletin boards, our subscribers have been in Games Workshop for years. It was a 99 ranked share for a long time. There's Whitmad saying he spent a number of years working in investment banks where he had access to broker research, and he found following their recommendations was a sure way of losing money. Look, I've got studies on broker recommendations too, and we've always found that the buy recommendations actually do a bit worse than the sells. So there you go. But anyway, Games Workshop, which many in the Stockopedia community, in fact, it was probably the most owned share when it tripled in 2017. They found it through stock screening and through the ranking system. And now the bulletin boards are abuzz with it, but all the big move is gone. So again, it's about finding ideas before the crowd. That's one of the great benefits of using the site. I know I'm just reinforcing this. You're all subscribers. I'm not trying to convince you to subscribe. So I just think these things are really important. It's what still motivates me every day, because I think private investors, and I've made so many mistakes myself. Building consistency and discipline in your investment process. And ultimately, it's about improving results. So quite straightforward. Now, the conceptual framework I like to think about around stock screening is quite straightforward. Essentially, it's about what factors drive stock returns. And you can break down the factors that drive share prices into a set like this. So firstly, there are company-specific factors. So the news on any share, for example. And the news on any share is, obviously that's what most people invest in. They want to invest in shares because they hear that there's going to be some amazing news. Sirius Minerals in the UK is a classic example of a share that was being driven, interest in it, by company-specific interest. Hopefully we're building this big mine, everyone was going to get rich. So that can drive shares. The market as a whole is like a tide that lifts all boats. And half an hour early, Alan's telling me that Scotland are winning. That's good. Anyway, the market will raise all boats as the tide goes up and down. But it's these other factors that are lesser known, which you would build stock screens around. Quality, the idea that profitable shares beat junk shares. Value, cheap shares beat expensive shares. Momentum, strong shares beat weak shares. These three ideas we've wrapped up nice and neatly into the stock ranks, which I'm sure you're familiar with. But also you can screen on specific financial ratios based on these themes, which I've got in my cookbook, some of my favorite ones. For example, here's the value ones. So you can use financial ratios or the stock ranks as you like. Volatility, so low risk shares tend to beat high risk shares. Sirius Minerals is an example of a high risk share that's gone badly wrong. We have some metrics for that. Also size. As Jim Slater would say, elephants don't gallop. Small caps tend to beat large caps. And you can screen for all these 5 kind of key concepts. And I should probably add the income or yield in there. But yield is sometimes thought of as part of value. But that's how we construct stock screening rules. And the reason to construct stock screening rules is because, as an example, this is a chart that shows value shares, the cheapest 10% of the market, versus the most expensive 10% of the market here. So expensive shares dramatically underperform the market, cheaper shares outperform. And I'm not encouraging everyone to go and buy the cheapest, very, very cheapest shares in the market, because they can be quite risky. But you can see this is the idea. If you screen and filter the market just down to certain classes of shares, you have this possibility of outperforming, and it becomes more probable. So I like to think of it as a filter. So you're taking a universe of shares. So anybody who's a novice in the market will go on and go, well, it's 1,500, 2,000 shares in the UK stock market. There's like, if you're a global investor, maybe there's 60,000 shares. There's maybe 10,000 shares on the US, NASDAQ and New York Stock Exchange markets, etc. So how on earth are you going to find a good one? And that's why everybody goes to a guru. They'll go to a broker or they'll go to a tipster and they'll try and find like the one share to buy. But obviously that's not a very rigorous process. So I like to think of stock screening as taking the full universe that you've selected and then adding rules. And each of these rules, I know these are little financial ratios that may be garbage to you, but this is a price to sales ratio, return on capital employed, relative strength, blah, blah, blah. But each one of those rules is constructed around one of those key factors or themes that I talk about. Value, quality, momentum, size, might be volatility, growth, etc. And as you add more and more of those rules, the number of shares gets whittled down to a small set of candidate stocks. I know I'm teaching a lot of you to suck eggs, etc., but a lot of you know this and it's taken for granted. But for those who don't know this, I hope it's helpful. Now, just to reiterate, and I'm going to give you a very, very quick look at the Stockopedia product, which, because for those of you that haven't screened before, and show you how easy this is, we have created the stock ranks around these ideas. I'm not going to go on about this. This is just one slide on the stock ranks. But obviously, many of you have seen the ranks on the stock reports, the quality rank, value rank, and momentum rank. And we rank every stock in the market from 0 to 100, where 100 is best, and they're all percentiles. So if, as you can see here, this momentum rank of 85, that means a share with an 85 rank is in the top 15% of the market, whereas this share with a value rank of 10 means it's in the most expensive 10%. So 100 is always best or cheapest or good and profitable, or whereas 0 is terrible. And you can think of it like that. So if I want to just show you how I can quickly find shares with just these ranking factors. And I'm going to do this before jumping back to my slides, just to give you a kind of a preview of, and I'm going to go much deeper into the ranking interface in a minute. But I do think the stock ranks is a kind of the simplest way to screen the market. If you've got that stock universe, you can just add these rules for the value rank, the quality rank, the momentum rank. And as their percentiles, we'll look in the top 25% of the market for each. And I can whittle that 1,500 stocks just down to 9. I hope this is going to work, and I will find 9. So I'll turn that off, and then I'm going to go into the app. So very quickly, there you go. I hope you can see this. I'm going to go into screens in the sidebar very, very quickly. And I'm going to click new screen. And you can see this is just a list of shares. It's got no rules added to it, but it's sorted by market cap descending. If I add rule, I can find the stock ranks right here. And if I scroll down a little bit, quality rank, add it, Stockopedia quality rank greater than 75. And the number of shares whittles down from 1,500 to just 390. Again, stock ranks. I know for those of you who already know this, I know I'm just showing you exactly what you know already. Adding the value rank again. Similarly, I'm going to add the momentum rank. And there you go. And if you don't know what, hopefully it's pretty obvious what I'm doing. And that's already down to 17 results. And if I can go into profile and find the size group, which lets me screen on the size of the company. And I'm going to choose small cap. Size group includes small cap. 9 results. So I've whittled 1,500 shares down to just 9 in literally an instant. And we can save that screen and be done with it. Now I'm going to give you a really good in-depth understanding of everything you can do on this page in a little while. I just wanted to illustrate that for the beginning to show you some of what's going to come. But before I do that, I'm going to give you a little bit more information about and show you how you can use our pre-rolled Guru screens and our Stockopedia screens without going into actually fiddly metrics, etc. Because if you're not someone who wants to go and fiddle with metrics, we've done a lot of the hard work for you. So we have this concept of the Guru screens, and basically we've taken 65 books on investing. I've got a few of them here actually. Let me just show you. I've got some, for example, What Works on Wall Street by James O'Shaughnessy, How to Make Money in Stocks by Bill O'Neill. I've got the Zulu Principle here. I've got one by another guy here. Lots and lots of books. Now, I've got a massive library, which was my own personal one, started with, seeded, but then the business has, we've added a heck of a lot more. And I think probably the best stock picking library maybe in the world, maybe definitely in Britain, or definitely the best one I've seen. And, we use all of those things to find and we'll look in those books, and we'll basically pull out all of the rules, from a specific strategy. So, for example, from here's Jim Slater talking about price earnings to growth factors, and we'll construct the rules based on what they suggest in their strategy. So, and then we create stock screens from it, and that's pretty powerful. And if I go down through these, I'm going to go into the Zulu Principle in a little bit more depth. But if you open them up and you copy the screen in the interface, you will see all this sort of financial data of metrics you might not have heard of. But ultimately at their core, if you look on the right, it's always about building some rules which are aligned with these factors, these themes of value, quality, momentum, size, etc. So this strategy by Jim Slater is all about finding good quality and growing shares at a reasonable price, which have some positive momentum, and they're smaller companies. If I look at the next one, the Can Slim from Bill O'Neill, he screens for growth and quality. I hope I've got time to go over it a bit later. But lots and lots of ways to screen for earnings per share growth. He looks for return on equity, which is a quality metric, and he's got 3 filters for momentum. Now you can learn a lot about financial ratios just by going into these stock screens and trying to understand what those metrics are. I learned tons about investing from just looking at how these guys did it. So this is Tiny Titans from James O'Shaughnessy. And basically, this is literally looking for cheap shares by their price to sales, strong momentum that are small. And it's pretty straightforward stuff. Now, I'm going to go onto the site and show you where you can find all these strategies, because this is I think they're pretty awesome. One sec, it's loading up. So we have moved these into the browse, into this tab called Browse on the left. So if you go in here and you go and click Browse, you will find you can browse lots of our strategies, market data, and so forth. We hope that we're going to Peter Higgins. Conkers is on the line. Fantastic, you're here. Say hi to Peter. Fantastic, a massively active private investor. And we've got, do follow Conkers on Twitter. Yeah, this is the problem. Most people don't read their investment books. They buy them and they sit on the shelf gathering dust. I have read, I wouldn't say all of the books I own, but very, very many of them. But anyway, the ones that we have modeled are in this section on the Browse page in Guru Screens. Now, in future, we'll be allowing you to favorite these so that they then pop up in your own screen section. But at the moment, they're here. And we've got these categories. We've got some popular ones on the landing page here. You can see Robbie Burns' Naked Trader screen here. But they're also categorized by a category, obviously. And I'm going to click on growth, but you can choose growth investing, quality investing, income investing. I framed this webinar around growth and income, so I'll look at those first. But on this page, you can see there's maybe a dozen different growth screens based on all kinds of different books. And you can see a little bit of sort of metadata about that strategy, if they're currently speculative, etc., what the average stock rank of the shares in them are. And you can look at a performance history since inception or in the last 1 year, or et cetera, et cetera. So you can browse the strategies and then you can click through. There's the Jim Slater Zulu Principles screen. Now, when you're on this page, and again, this is if you're learning and you've never done stock screening before, this is a great way to learn. And on this page, you've got, yes, a title, and there's a link here which actually will open up, I'm pretty sure, to Amazon, where you can buy the book if you're interested. I don't believe we earn any money from that at all. So, it's not like but I've read tons of these books and they're fantastic. But there's a nice little standardized description all about it, and there's often some jumping off points to learn about the financial ratios. So, for example, if you do want to learn about some of those ratios, you can click the link and you will be taken to a description all about that field. So that's pretty useful. You can see the rules here broken out into little, they're called little chips, basically, but they're sort of summaries of each of the rules. As I said, you might not know about financial ratios, but reading the description, you'll get the gist of what it's about, and you'll start being able to learn about how it's constructed. You've got the performance history here, so you can see in the last year, this strategy slightly underperformed the market, possibly by 9% down in the last year, but since inception, massive outperformance. You expect growth strategies to possibly come off more than the market, especially if they're a bit speculative when the market is treading water. They tend to massively outperform in rising markets. So there we go. Oh, yeah, someone's asking me about data sources. Absolutely. I probably should have put a slide on data sources. I'll try and add it to the deck before I move on. But the data, our data, I talked about this actually. I did a webinar 2 weeks ago. So just hold that thought. I'll talk about the data in a little while. So anyway, Jim Slater, you can see we've got the performance history here. And then down below, you've got a set of candidate stocks. And these candidate stocks, there's only 9 in here at the moment. The rules that make up the screen and the financial ratios, they will be in the table. And I'll talk a lot more about how you can use this table and edit it and customize it and all the more, and the different ways that you can look at all these shares in due course. Here you can see like lots of the charts and so on, but I'll talk more about that later. There's a nice button there that says copy, and I'll be copying this screen in just a minute to talk a little bit more about it. Some of you asking about when to sell. And I'll hopefully come and talk a little bit more about that later. Some of the things about these screens, we track the performance on a quarterly basis. So every time there are new candidates, every quarter, we roll the tracking into that next new set. I certainly wouldn't recommend rebalancing a portfolio quarterly, especially in small caps. Trading costs are not included. So while this has done almost 300% since inception, there would be trading costs associated. But it's very standard to do performance tracking without the trading costs. And this is similarly to the AAII who do this in America. You can actually, personally, I rebalance my portfolio more like annually, but I do it on a rolling basis. So I do some quite a bit every quarter and occasionally a bit in between. But I certainly wouldn't rebalance the whole portfolio every quarter. But these give a very good indication of the sort of the relative performance possibility that you can get from these sorts of strategies. And if you know Slater Investments, who base a lot of their strategy on this, you'll know that Mark Slater, who runs the fund, has done very, very well in small caps. But anyway, that's a bit of a run through about each of these strategies. Every single one of these pages, you can find the way we've done it. There's Robbie Burns' Naked Trader strategy, a lot more rules there, and you can copy that, etc., etc. Income investing screens, some of these have done very well. And one thing I did want to point out is if you go in here and you look at some of these, as you can see, some of these have done very well, but we're only at the moment tracking the capital return. So this is not a total return tracking performance at the moment. And I appreciate, don't beat me up about it. It's very much on my mind. We're trying to get the full total return performance tracking into the Stockopedia application. But you can see that a lot of these dividend strategies have done very, very well in spite of this not including dividends. So if I go through to the quality income screen right here, you can see this has done, it's pretty well. I mean, it's done certainly better than the market, not massively better. But the yield that you get on these stocks is significantly better than the market. One thing to point out is that if you go to the home page, you can see the median dividend yield on these indexes, maybe 3.8% on the FTSE 250. If I go back to that previous screen I was on, this quality income screen, and you scroll down, you can see that the typical yield on these stocks is more like 5%. Median is 5%, maybe the average is higher. Some very high yields, but maybe a bit more risky. So, even though this performance is only up, 57% over these 6 years, that's also 5% plus a year in terms of yield. This strategy uses a range of quality metrics, but to try and make sure that they are good and fairly safe dividends. And you can go and browse these income strategies quite easily. There are some here that are popular. This one's based on a book by Kevin Mattress of Zacks that focuses on growth and income and has become quite popular with subscribers. So anyway, there's a lot to dig into there. I'm not going to spend too much more time on that. There we go. So anyway, yes, I'm getting some good questions about the data, and I'll try and answer some of your questions when I go into a little bit more of the advanced stuff in a while, because I think that's quite important. So do remind me if I don't, because I'll talk about our data, the way that we do our data, and I do have a slide elsewhere which I can explain it, and also the different types of data that we've got, because some of you are saying some of the data is different to the ones on the stock report, and I think it's important for me to explain why. Anyway, that's really great to browse. You can learn tons from these guru screens. Here's a little Tiny Titans one. I mentioned it in my slides by James O'Shaughnessy. And this literally looks for shares with good momentum and that are cheap. And it's really smashed the market. I like to call it a value and momentum screen. Again, looking back at those factor ideas, all that's trying to do, these screens are trying to do, and I want to try and get a way to visualize this for people who are sort of beginning out on investing. It's about taking those factors and stacking them up. And once you get more familiar with financial ratios, you can go and sort of go a bit more fine grained and create your own. But before I go and do some of that with custom screens, I want to show you a little bit about our Stockopedia screens, because these are based on the StockRanks. And so if you go in here and go Stockopedia Screens, you can see there's a few buckets here. And I'm going to focus on the top one, which is a set of screens that we've added. They're not available on the old site. They're only available here. And it's about top stock ranks. And some of these have done very, very well. Now, I was talking about quality, value, momentum, growth. Well, we like to summarize them with their first initial. So you will see around the site things like QM, VM, and that simply means value. VM means value and momentum. QM means quality and momentum. QVGM means quality, value, growth, and momentum, etc., etc. Obviously, the overall stock rank is quality, value, and momentum. But these metrics, and I'll be showing you a little bit more about them later, but you can filter the market based on just these. Now, these are pre-rolled. So you want to find the top stock rank shares. You can click top stock ranks, go through. That's another screen that's done very well over the years since we started tracking. These trackers actually started a little bit later than the other Guru screens, so they're a little bit behind. But this is a very simple screen using the stock rank, sorted by the stock rank, and just filtering out some of the real tiddlers. If I go back, I can show you top value and momentum rank. So this is like that Tiny Titans screen, but it uses the VM rank, and which is a composite of the value and momentum rank. But you can screen for something very similarly, just using a value rank rule and a quality momentum rank rule. And this is just using a couple of factors to find a very good filter. And we track the top 25. Very important to state this in all of our Guru screens and these Stockopedia screens. We track the top 25. So all those have got 109 results in the list. When we track it, we only use the top 25. We build a portfolio and we track that over time. This is slightly different to our overall stock ranks tracking because remember, these are screens. So I hope that I'm making sense. If I don't, you do let me know. So does it? Yes, good. I'm glad you reminded me of this. I did say this for international investors. Now, for example, if you are an international investor and you're in, let's say, Australia, you would see something a little bit more like this. And this is, we only started our Australian subscription back in 2016. But again, that value and momentum strategy has outperformed considerably in that time frame. And here you can see all the Aussie stocks. I might not know them so well, even though my in-laws and my wife are all Australian. And I was in Sydney at Christmas, actually. I love it down there. Much better weather at the end of the year. I might end up trying to go there every year, but at the moment, only once every 2 years for me. But anyway, you can see, yep, there they are. And if you are a cross-region subscriber and you have, added on, you can add on these regions, by the way, by going add regions, and you can change your subscription. If you do have a multi-region subscription, you will see lots and lots of different strategies here all together, all on one chart, and they'll all be stacked up. And it will blend them all together here. So I use this filter up here because I like sort of focusing on one region when I'm picking stocks from that region. Anyway, so I'm not going to cover too much of the international because most of you are UK subscribers. But if you are an international subscriber, do bear that in mind. And I'll show you how to screen by country later. Anyway, so one of the things I would like to point out before I go on is that if you do like any of these sort of stock rank strategies that are on here, if you want to turn them into an income screen, literally go to one of them and, let's go to the value and momentum rank. You can just click copy. And I'm just going to say copy of VM rank, number 1, make a copy. I've made my own copy. I can now edit it and I can add a rule. So I can add a rule for let's say for the yield, search for the yield and click dividend yield, add it, and I'll try and find just, let's say, 3% plus yielders. There's 68 stocks that have good value, good momentum, and a good yield. So it's very, very easy to turn any of these strategies into dividend strategies whenever you like. So pretty important. Now, I am getting a few questions about market timing. So I'll try and talk about that when I come to momentum and technical filters in a little while. I want to go back to the Slater screen because now I'm going to ramp it up a little bit and talk a bit more about sort of individual metrics. So if you're someone who's a novice, you're going to get tons out of this. but I'm going to start going a bit more deep into the interface, as well as talking a little bit about financial ratios. So the Slater screen's a great screen. You'll find some really good stocks in it. But I want to sort of explain some of the bits and pieces from it. Now, as I said, you can go into Browse, go to Growth, and you'll find the Zulu Principal screen right there. Now, as I said, I wouldn't have started Stockopedia if it wasn't for this book. So it's still very close to my heart. It was the first book I read after I left university, more than 20 years ago, maybe 25 years ago. And this strategy helps you find growth at a reasonable price shares. Now, Jim Slater, he died a few years ago, very sadly. I did meet him, and he said to me in person, I was like, "What advice you got for me?" And he was like, "It's all about the criteria. It's all about the rules." And he was very, very numerate, trained accountant. He was a real sort of cutthroat capitalist when he was young, but he ended up writing a column at the Telegraph called The Capitalist before he wrote all his books on investing. And eventually, him with his son and a few others, they created Slater Investments, which is now a successful fund management firm. But of course, they do very well, but one can do better applying his principles by oneself. And that strategy has done very well, as I showed you. Now, I want to talk a little bit about the fields that go into this in a little bit more depth. And so just going to spend a little moment on this, and then we're going to go in and going to copy his screen, and we're going to start building a custom screen, and I'm going to explain all of the interface. I know I probably do need to do a day's course. Whenever I put these webinars together, got some good questions coming in. When I realize when I'm doing this that I cover too much material, and really I could spend a day on stock screening. I could probably spend a week talking about all this stuff. So I think I probably will at the moment doing the webinars, but I probably need to slow them down a little bit because I'm kind of doing product education and investing education at the same time. So anyway, back to this. In the interface, you'll see these rules if you copy the screen, as I will in a minute. And I want to talk a little bit about how Slater, in his books, The Zulu Principle and Beyond the Zulu Principle, finds these great growth shares. So for him, he was interested in finding growth shares that are not too expensive. And he did lots and lots of reading on investing. And essentially, there are some key principles. He'd try and find relatively inexpensive shares. He was willing to pay a bit of a premium for them. So I'm presuming everyone knows what a PE ratio is and the yield is. I'm not going to explain that. If you don't know what those are, you can find lots of information on the website, and I'm just going to presume you do know that. So the price earnings ratio, very, very most popular valuation ratio, he was willing to pay a little bit of a premium, maybe up to 20 times earnings. But he used and then he wanted to find shares that were growing. I've sort of bundled this naughtily into quality, but the earnings per share growth. So he would forecast a year ahead using the broker's consensus forecast, and he'd look at the EPS growth that they were projecting. He liked to see earnings per share growth greater than 15%. In other words, next year's profits 15% more than this year's. That's a pretty punchy growth rate. And he'd try and make sure that he was buying that growth at a reasonable price. So that's why. And what he would do is he'd use a key ratio called the PEG. He was one of the great popularizers of the PEG ratio. If you go on a stock report, and I'll show you, I'll go on the stock report and I'll find his strategy. So growth, Zulu Principle. Hang on a minute. Let me go back and share my screen. I'll just look at one of the shares on this list. I'll just look at the top one, Sylvania Platinum, and click through. And here you can see on the right, these are three of the ratios that Slater used: the P ratio, the PEG ratio, and the earnings per share growth. This stock has a 35% growth rate for the next year, and it's got a very low PE ratio. Perhaps that's one of the reasons it's been flying lately. You can see the share price gone up. Cripes. If you don't know what anything means, you can, of course, click it on the site. So if you don't know what the PEG ratio is, click it on the stock report and you'll learn all about it. But the PEG ratio is only 0.2. Now, going back to my slide, Slater, he liked a PEG ratio of less than 1. Now, the PEG ratio is the PE ratio forecast well, his version, divided by the earnings per share growth rate. And he liked it to be less than 1. That means that the earnings per share growth rate is higher than the PE ratio. So, he's looking for that kind of share. Now, I'm going to talk a little bit more about the PEG, because I think it's a very powerful measure. And if you're a growth investor, it's a really, really useful one. If you're somebody who likes to buy things not too expensive, because I know there's a lot of growth investors who like buying shares on very, very high PE ratios, but there's a different approach to that. And the PEG ratio is calculated by dividing the PE by the EPS growth rate. And a PEG of less than 1 indicates the growth rate's higher than the PE ratio, and a PEG greater than 1 indicates it's lower than the PE ratio. So you can think basically, if the growth rate is, let's say, 45% over the next year, you'd be willing, as a sort of Slater style investor, to pay a much higher PE ratio of up to, he would put a cutoff of 20 times earnings, but you'd be looking to try and not pay too much for that growth. So, if you've got a stock on a P ratio of 10 and the growth rate is 15% for the next year, that will have a PEG of less than 1. And basically, the rule of thumb is to buy good growth stocks when the PEG is less than 1. Now, some people have asked me, why is the PEG ratio in the Slater screen different to the one on the stock report? I don't really have time to go into the details, but the Slater PEG, and we have different versions of the PEG, and we have different versions of the P ratio, and I'll show you later in the more advanced section about some of these little blue comments here, modifiers on each of these fields, and explain what they mean. But essentially, Slater like to use the forecast PE and the forecast growth rate, and that would create, it sort of double counts the growth rate, but I won't go into that detail too much. So anyway, he likes finding growth at a reasonable price, but he also likes looking at stocks that are good quality. And the metric he uses for that is probably, one of the more popular quality ratios, called the return on capital employed. You can think of that as the amount of operating profit divided by the amount of capital in the business. You can think of that as the debt and the equity in the business. And that really is like, let's say a company with a 12% or more return on capital employed tends to be a good profit engine, especially if it's been sustained over time. So Warren Buffett, Slater, whoever will look for higher return on capital employed companies, and they can do very well if they sustain a high return on capital. And we have that published again on the stock report. So all of these metrics are on the stock report because Stockopedia was so inspired by company refs, which Jim Slater devised. There is the relative strength here. Now, again, relative strength, one of the most important fields in stock screening, and I've got a slide on it right here. So relative strength shows you the share price performance relative to the market benchmark. In other words, if you're in the UK, it'll be the share price performance against the FTSE All Share. If you're in America, it will be the S&P 500. If you're in Australia, the ASX, I think it's the 100. But we use the standard benchmark and to compare every stock's share price performance against it. So shares that are beating the market will have a positive relative strength. So this chart shows a share recently, I was looking at Marshall's, which had gone up 14% in the last 6 months. I'm looking at 6 month relative strength against 2% for the market. And that created an 11.5% relative share price strength. Now, the reason this is very powerful is there's been a ton of academic research which shows that shares that are going up, beating the market, tend to keep beating it over a certain time frame. Shares that are declining and underperforming the market tend to keep underperforming. And this is a really magical piece of data, which actually Slater got from James O'Shaughnessy in his book. I actually haven't prepared this, but I do have O'Shaughnessy's What Works on Wall Street, which has one of the best studies on relative strength in it. This is, if you want to get to know market data, buy the latest edition of O'Shaughnessy's What Works on Wall Street. It's a very, very thick, heavy tome, but there's lots and lots and lots of charts, and it explains all about rule-based investing, and it's fantastic. And it's like cookbook of financial metrics. But anyway, Slater got the idea of relative strength from him, applied it in his screen, and it's been applied in lots of stock screening approaches ever since. Look for shares that are beating the market. You're a small investor, and that there is a tide. There is you can think of the market, and you think, well, the market is driven by big investors. Okay, so you've got lots and lots and lots of funds out there, and as a small investor, the one great advantage you have is that you're small. You're like a little boat on a sea and an ocean that has these massive surges, which are driven by the movements of the mega funds. And mega funds can't buy shares quickly; they have to buy shares over time, and that creates these trends. And I think, a lot of private investors are skeptical of momentum. I'm not saying that everyone should go and buy the highest momentum shares in the market. A lot of people are uncomfortable with that. But I would say buying shares that have better momentum than the market as a small investor makes so much sense. Momentum is the most powerful factor in the market. And that's been proven. And I have a quote from the two original academics, Farmer and French, who won the Nobel Prize for economics based on their work into factors. They said it's the most powerful factor of all. So momentum, although value investors, of which most private investors are value investors, they don't like it, but that's quite short-sighted. So anyway, the simplest version of momentum is the momentum rank on Stockopedia, but relative strength is, I think, a fantastic metric. So Slater would use relative strength to find stocks that are good, quality, growing, value, beating the market, and he liked to say elephants don't gallop. So he looked for a smaller cap shares, and in his book, he put a market cap of 20 to 1,000 or 1 million, 20 million market cap to 1 billion market cap. Whereas, and that he was writing 20 plus years ago, in fact, even maybe 30 years ago. So you probably could expand his range a little bit. He didn't like buying the really small caps shares. And so you probably should expand that range. But I think that's quite an important thing to understand. So I wanted to where can you find relative strength on a stock report? Good question. And I'll show it to you. We've got lots of relative strength measures on the stock report. Going back to the share I was looking at, you've got right here, momentum, relative strength right there. We publish 1 month, 3 months, 6 months, and 1 year. I'm, to be honest, a little bit uncomfortable having 1 month and 3 month momentum there, because the two most important are these ones, 6 month and 1 year relative strength. So if you look at these two numbers, that will tell you instantly whether the stock is beating the market over those time frames. And a very key concept to understand about relative strength is that its sweet spot is 6 months to 1 year. I've got another book actually about it, which actually says 7 months is the best. But there is a concept of what's called reversal, and there are momentum reversals at about the 1 month point. So this being green when it's positive is a little bit misleading, because often shares that pull back have a tendency to bounce. So don't worry too much about that. Also, relative strength over 5 years tends to reverse as well. I did write quite a good, I think I wrote a good article on this a long time ago. Let me see. Where is it? I can't find it. I may have to find it for you. But anyway, we do have some good articles on relative strength. And I go into that a little bit more. But effectively, relative strength reverses at very short and very long-term timeframes, and its sweet spot is 6 months to a year. So look there and use 6 month or 1 year relative strength in any stock screens you might use. So I think that's a good way of understanding it. So I'm just really what I'm trying to do is trying to sort of demystify some of these fields somewhat, relate them to these conceptual factors, and show you what this guy is trying to do. Now, a very important point with Jim Slater is that he uses stock screening he always used stock screening as a first off jumping off point. Now, I'm more of a hardcore quant, so I've always liked to just buy from stock screens. But there are two issues with buying straight from a stock screen. And the risk is that you could buy a dud. So if you buy one share from a stock screen, it could very well be a dud. Now, there's two ways of managing that. One, you can diversify broadly across lots of shares in a stock screen, and that minimizes your chances if one of them is a dud, and hopefully you just get that general payoff to the screen. The other thing is you can do a lot of qualitative research, and that's what Jim Slater liked to do. So he had a few other nice to have things that he looked at. He liked to look at more metrics such as the debt level. He'd like to think that a company with a gearing of less than 50%, again, that's on the stock report. He sometimes looked at the quick ratio and the current ratio. I won't go into what those are. And some nice to haves. He liked to buy shares that were buying back, paying a dividend. But he also looked at qualitative factors. And this is the kind of thing that the stock pickers on the discussion forum of Stockopedia will be looking at. And it's always fine. I know not all of you will go onto the discussion boards, but it's super friendly. If you have a question about a share and you're like, just ask a little bit about it. And the community are very, very knowledgeable. Very proud to say we've got fantastically erudite, knowledgeable community on Stockopedia. But some of the key things to look for in qualitative investing is Slater loved something new. So he wanted a catalyst, new technology, new management, new events. I'll send out these slides later, so you will get them. And he liked to see strong management, maybe evidence of success previously. He liked to see them buying shares in the company or having a good stake. I know that Lord Lee, who I know, really likes family-run firms, management with family-run firms, because they're more vested in the success. And also competitive advantage. So he'd look for a good brand, good patents, dominance in markets, especially niche markets. Think of Games Workshop, really real dominance in that niche market. He loved retailers that he would say were cloning their operations. Classic example was Domino's that did so well over the years. Anyway, that's something he would do. I'm probably going to rattle on a little. I've probably rattled on too much about that. I'm conscious I've already been going for an hour. But I think I'm going to just go on straight into custom screens because now I think I should really show you a little bit more about the power of the new interface because that's really, really super. So going to go on. I hope I've helped a little bit in understanding that Slater screen. So I'm going to show you what to do. Oh, one thing, if you didn't know this already, but on the stock reports themselves, you will see this little widget here, which will show you how many Guru screens a stock's qualifying for. So you can see this one, Sylvania Platinum, is qualifying for 6 screens. I don't own it. In fact, it was in the my NAPS portfolio a few years ago and didn't do very well, but it was probably around this period. And ever since it's moved out of that, my strategy, my portfolio, it's done really well. Such is life. But the 6 screens that it's qualifying for are all here. And you can see that this is qualifying for here, the Slater Zulu Principal screen. And you can click right through to go to the screen. So if you're on a stock, you can quickly scan which Guru screens it's qualifying for. And that's pretty useful. So I'll go back to the Zulu Principal screen. Now, you can see this button up the top right, allows you to copy it. Now, at the moment, you're not following it. We will be adding that a feature later to favorite this, but you can duplicate it to make it your own. I'll just call this, Zulu Slater 2. I'm going to get rid of that description and make a copy. But anyway, I can duplicate this and it makes it my own. And now I can edit it and I can see all those different fields I was talking about right here. And what I want to do is I want to create a screen from scratch because, but before I do, I can start tweaking some of these little filters and I can edit the rules as much as I like. I can make them, fiddle around with it so I get different numbers of results when I do. But let me start by constructing a screen from scratch. Now, the way I do this is I click New Screen up the top left, right? New Screen, I've got a blank page, and there's not much on it. It's got a default sort order here, sorting by market cap descending. And I'm happy to keep it like that at the moment. And you can see there are 1,525 results. Now, the interface shows me all the stocks that qualify, and you can browse all of them. So on the old site, you could only see the top 200. Now you can see, you can go right to the bottom of the list, go to the 31st page, and see, you can go and really, really browse deep into the stocks that qualify. Now, every time I add a rule, I'm going to whittle this down. So let's say I want to find good quality income stocks. I would click this button, add rule, and let's see what happens. Up pops this select metric pop-up. All right. And yes, Steve, you can screen by free cash flow and yield. You can screen on all kinds of metrics, and I'm going to get to that shortly. Selecting by metric, you can see in this interface, you've got a bunch of categories on the left here. Some profile metrics, which are often the classifications on a stock report. The size metrics, including market cap and some other bits and pieces. The stock ranks, so the overall stock ranks there, and some different varieties of different ranks, including the quality, value, momentum rank. Quality. Now, in each of these categories, you'll find the quality rank duplicated. Sorry, the relevant stock rank duplicated at the top, as well as more fine-grained measures. So here you can see quality, and you can see return on capital employed, the quality rank there, etc. So you can use these categories, go down, value, momentum ratios, lots of momentum ratios. I'll talk a little bit more about that later. Growth, dividends. So if you're a dividend investor, first thing you might do is look for the yield, add it. In fact, I'll just do that right away because this is about finding growth and income stock winners. And you can see when you add the rule, it says dividend yield, and we can say greater than, let's look for a yield greater than 3%. I'm sure everyone wants better than inflation and at least a decent yield. So there you go. Now, the default universe you're screening on will be which will likely be your subscription region. Might be if it's the UK, but if you're on an international plan, it might be one of the other countries or a combination of all those regions. If you do have an international subscription, you can add a filter just by country, which is very useful. So I'll just show you how to do that. You can go add rule, profile, country, or region. Look for the country, add the country. Country includes United Kingdom. There we go. And we're already in the UK, but that's how you would do it. So if you're on an international plan, you want to make something just about a specific country, you can do it that way. So quite easy. And you can do multiple countries. You could do UK, Germany, France, blah, blah, blah. So it's quite easy to find fields or metrics just using these big categories on the left. Analyst shows you all the broker recommendation bits and pieces. I'll talk about that later. I'm not going to explain every single field, but shortly I'll go on to talking about this little cookbook that I want to share with you, which I will send to you while you're here. I'll try and, I'm not sure how to attach it, but I'll try and figure it out. Now, if I wanted to find growth, I could go, let's say I want to find growing yield shares. I could go to growth and I can add, look for earnings per share growth. Click it, and you'll see in the interface, I've got basically the main category here, and there's these little gray subcategories. So earnings growth is here with a whole bunch of variety of different earnings growth or profit growth measures. I'm just going to use the very standard earnings per share growth. Now, it's important to understand that we have a variety of different measures of just this plain vanilla field. So TTM, I will explain later, but that's a trailing 12-month ratio. It's a historic field. But you can also use forecast data, forecast 1 year. I prefer the rolling 1 year forecast. That's what Jim Slater would have used. I think it's one of his great contributions in this domain. Or he certainly popularized it. Not sure if he came up with it. But I like to use, when I'm using forecast data, the rolling 1 year forecast. And I'm going to add that. And I can try and find earnings per share, companies growing by more than 15%. So earnings per share, you've got the field, the operator. You can look for greater than, less than, etc. And then the value. And this is very handy because if you don't know what unit it's in, we actually pull down the units right there. And so this shows you it's greater than 15%, which is, I think, pretty cool. Now I'm going to I've got a little checklist of things I want to show you. And I want to show you search. So if you click add rule, you can search. So I could search immediately just by typing in this little field up here, this little search box. I can search growth, and you can find earnings per share growth. And they're all split into these different categories. And it's super powerful, the category and the subcategory. And I could have found earnings per share growth like that, click it, and it pops up in the hierarchy, and I can add the rule. I've just done that, so I won't do it again. So now I've got 83 stocks with a yield above 3%, forecast to grow their earnings by 15% over the next year. And I'm still sorting this by market cap descending. I can change the sort either by clicking on, and what's particularly cool is whenever I add something to the interface, it immediately live screens the results. So let me just show you. And it also will add these fields as columns without me having to edit the table. That's a super advancement on the old system, where you had to customize the table sort of manually. So it's adding it live. Let me show you. I'm going to look for very high quality shares. So this time I'm going to use the quality rank, Stockopedia quality rank. There it is. Add the rule. Stockopedia quality rank greater than, and as I said, these are ranked out of, let's say, 100. I want to find stocks that have got quality in the top 25% of the market. And instantly the quality rank is added there. Yes, great question. Can I export a list of ticker results? Really glad you added that, because I actually forgot to add that to my notes. So yes, you can. If you scroll down to the bottom, there's a download page. There's a download option. You can download to CSV, Excel, or copy the data if you just want to go and add it to Google Sheets. So that's very powerful. So there you go. Now, the sort order, the sort order is right here. And let's say I'm currently sorting by market cap descending, as you can see. I can click one of the other columns, and it live sorts it and updates the sort here. But I can also sort by something which isn't in here. So let's say I might want to sort by, let's say, StockRank, update, and it's added the StockRank, even though it's not in those rules, into the interface, StockRank descending, and bang, there it is. Now, once I've got that down to 28 stocks, that's pretty cool. That's I'm just going to save that, and I'm going to call that growing, yielding quality stocks. And I don't need to add a description. Save. Done. I've got that saved. And look, it's in my sidebar here. I've got it here, and I can drag these up and down in my screens, in screens. So if I've copied a Guru screen or even another stock, I've got some good questions coming in. But this little toggle here, where my little, I hope you can see this. There's some little dotted icons on the left here, and you can drag these up and down depending on the order you want them to be in. And your favorite screen, put it at the top, because if I click away and I go, let's say, to portfolios, and then I go back to screens like this, it will load that screen I've got right at the top instantly. And that's super cool. So this will show me my title. It will show a summary of my rules when I come back to it, and then you've got all of the stocks down here in the list. Now, one important thing to understand, I'm just going to show, have I done, one other thing I wanted to show you. So most of the fields in here, add rule, most of the fields in here are numeric. But in the profile section, which I think is very important to get to know, we have the sector, the industry group, the risk ratings, the size group, stock rank style, country, indexes. These are all classifications. So if you want to, let's say, screen on a sector, add the sector rule. And I'm going to go excludes financials. Okay, let me say I don't like financials. There's 10 sectors in there, and I've removed all the financials from it, which I think is pretty important. Not sure why the sector isn't showing up here, but I can show you how easy it is to add. And if I save that, so for example, all of these different classifications you can use in whatever way you like. And I can go size group, excludes. I like to exclude micro caps. And there you go, 17 results. And if we save that, there we go. You got it saved, 17 results right there. Now, pretty powerful. So there you go. Now, once again, just getting to know those areas. One other thing I wanted to point out is that if you go, you'll notice these buckets: quality, value, momentum, dividends, growth. And size. They relate to those factor areas I was talking about. And one of the really nice features on Stockopedia is if I was to add a momentum measure, let's say relative strength, and just being careful not to use the 1 week relative strength, I'm going to use the 1 year relative strength by clicking that drop down and going 1 year. When I add it, the operator instantly chooses the direction which that factor goes in. So I want it to be greater than 0. And you can see 7 of those are beating the market over the last year. So I've quickly whittled this down into a great list. If I was to use something like, if I was to add the price earnings ratio, if I search for price, I can find the price earnings ratio and I add it, you can see how that instantly chooses less than, because price earnings ratios are tend to be the lower the better. So if I go less than 20, well, there's only 3 for that. But this operator will instantly be selected depending on that type of field. And just to show you a little bit more, in the interface, you get this lovely little description about the field in question. And there's a read more toggle here. So if you want to learn more about it, the instant thing at the top shows you the definition, but read more gives you a lot more context about it and might give you some other things to go and look at. And we'll also show you the unit size and how it ranks. So it will tell you lower is better. So for example, the P ratio, it kind of generally as a factor, the lower is better. But anyway, there you go. So I just want to make sure search I've done. I've shown you the category metrics, adding rules. I've showed you several types of data, showed you the rule type, and numeric fields. Yeah, so if we did screen on market cap, which is a size metric, which is in my cookbook in a minute, add the rule. You can see here it says GBP, millions of pounds. So you know you're dealing with hundreds of millions of pounds. You can change to dollars or euros, or a variety of different currencies if you want. And if you are in America, it will probably by default show you US dollar here. But that's really helpful. So this metadata helps give you context to what the field is like. Very, very helpful. So I will explain a little bit more in a minute. And okay, where to set the value. So what if you don't know what to set the value at? Now that's where this comes in handy, my cookbook. So I'm going to see, I'm not sure how to do this. So it's good to see we're getting through. It's been an hour and 12. I'm glad you're still online. I think once I go through the cookbook and some of the more advanced stuff, I'll be through it into the Q&A. So hopefully we'll get through that fairly swiftly. But as I haven't done this before, okay. Before I get on to the advanced one, this is a great question actually. And I'm going to show you very shortly, I'm going to tell you how to customize your display. All right. Now that's customizing this table display to be what you want. Now I was asked a very, very good question there. So why is the yield that I've added different in the list than on the stock report? So let's look at Highland Gold Mining. And I'm going to, oh, sorry, I'm not sharing my screen. Hang on a minute. Let me show you this. Get rid of my face. Right. I was just showing that you're on here. Someone asked the question, why is the yield different to the one on the stock report? So what I've done is I've screened here based on what's called the TTM yield. I'll explain it in the more advanced section in a minute, but that's a trailing 12-month yield. It's historic. So you can see a yield here of, I hope you can see, it's quite small, but maybe I can zoom in a bit. 5.94%. But on the stock report, the yield is 3.63%. Now, it's very common to say why, and I don't blame you. Well, it's important to understand that there are different types of metrics, and our data, and I'll talk about quality of data, I hope, in a minute. Our data, we create some fine-grained data for different purposes. So on a stock report, if a stock has forecasts, it shows you in this little section what's called the 12-month forecast rolling data for these 4 key measures: P ratio, PEG ratio, earnings per share growth, and dividend yield. Most growth investors or even dividend investors are often looking forwards to think, what yield, what growth will I get in the future? So by default, we show the forecast here. Whereas you might find down in the table, the yield, if I know where the yield is, it says 5.94% here. That's the trailing 12-month yield in the table, which is different to the forecast yield. So funnily enough, this stock has a projection of a lower dividends per share. That's a red flag for a dividend investor. But and there may be some reason for that. I don't know why. Maybe they're doing capital expenditure. I'm not sure. But anyway, the forecast yield is different to the historic yield. So that's why you can see the TTM yield is here, whereas in the stock report, it's rolling yield as default. So always make sure, and that's something really cool on this table, is you can see what I call the modifier of the metric underneath it. And Adam, who's designed this, has been really, really good at showing if there is a certain context to the field on it. So as I edit the field, I can go into the yield here. And you can see here, if I was to choose the rolling 1 year forecast yield, it would be the same as on the stock report, right? So I can't remember which one I was looking at. Highland Gold Mining, that's 3.63%. Which is the same as the one up here. So there's different types of data, and I'm going into that in a little bit more data in a minute. There you go. So that's a little bit of context. Now, I want to go into a couple of quick things about managing your rules. Now, I think this is quite useful. On the right here, you can see you can disable your fields without them being deleted. So this checkbox, as you can see, 14 results. If I remove some of these metrics, it will hopefully go up. Yeah, it's gone up to 29. So without deleting the rule, I can basically disable or enable it, which I think is very powerful, and allows you to sort of muck around with them. You can change the order. It won't change the number of results you get, but sometimes for organization, you might want to keep your, let's say, quality fields together, and you might want to keep your size metrics together, etc., etc. So it's a nice way to organize your field in a way that makes sense to you. And again, wherever you see that little ... icon, it lets you move things around. So, and that's quite common in the interface. And the little delete icon lets you delete them. So that's pretty important. I'm going to explain what this does, the dual list, in just a minute. Right. Anyway, so I'm going to answer some more questions in a minute. I'm going to try and share this. This is my little cheat sheet. I'm going to spend a little bit of time going on this financial ratio cookbook. I was doing this last night. I cobbled this together let me say, I don't know how I add this. I'm going to try and drag this. How do I do uploads? Offers, videos, file sharing. Right. Let me try and drag this in. Share a file. Sam's already done it. The financial ratio cookbook. Share the file. I hope it's the right one. You should be able, I don't know if you can see this in the chat, but it's being shared. I think you might have something which says file sharing in your chat box, but I can't seem to drag it in, but it should be available to share. Sam, if you're listening, do help them find it. But anyway, it's in the interface. On the right, there's a little thing called file sharing, and you'll see it's a little PDF. Now, I'll just jump straight to my slides, and I'll talk you through what I've done here. And here, financial ratio cookbook. So what I've done is about 10 pages. It's got the name of the field, and in the left. The first page is all about stock ranks. It should be fairly self-explanatory. There's an explanation, and then there's a sort of a suggestion for the screen rule with a certain type of cutoff on the right. So, for example, starting very basically at the stock ranks, quality rank, value rank, momentum rank, you can search for in the metrics builder, and you can perhaps you want to look for stock quality rank greater than 75. Similarly, what I call the combo ranks that I explained earlier. So, quality and momentum creates a quality and momentum rank, or the QM rank. Again, you might want to use 75 for that. Similarly for the overall stock rank, etc. That's pretty straightforward. Again, for the classifications, I've pulled some out here. If you've been on any of my more, ranks and ratings webinars, you will understand the risk rating. I really don't like highly speculative shares, but the risk rating gives you a 5 classification system, and I would set up a rule which excludes highly speculative shares. That's the easy way to do it. I like having some adventurous shares in the mix. If you're very conservative, choose conservative and balanced shares, but that's pretty straightforward. There's also the stock rank styles for people now, importantly, these classifications, you'll find at the top of stock reports. If I go back to Stockopedia, and we go and look at one of the shares I was looking at. Which one was it? Was it Sylvania Platinum we were looking at? Up at the top of the stock report, it says basic materials. That's up here. It show if I never ever know how to do this. So if I go and put I think I can actually draw on the screen. So you see here, oh, look at me learning how to do webinars better. But essentially, you've got there the classifications. So the sector is here. The risk rating is here. The size group is there. And the StockRank style is there. Each one of these is a classification. And they're really powerful and you can screen on them. And I do recommend that you get to know them. I'm going to turn that off now. Yay. Okay. So anyway, that was quite me just wanting to use one of my toys, but you can screen based on these and that's very, very powerful. But in my cookbook, which hopefully you've got a copy of now, it just has a suggestion of how to use these 3 of these classifications. And if you want to know more about them, go into the, I hope Sam has shared with you the stock report webinar I did a couple of weeks ago. It's super powerful. Size groups, I like to exclude micro caps. So did Jim Slater. We have 4 size groups. Some people prefer small caps. Some people prefer large caps. If you're a dividend investor, you might prefer mid caps and large caps. Unless you're a dividend growth investor, you might prefer looking in small and mid caps. But that's pretty powerful. Now, quality. I'm going to go through this because you can use this in your own time. It is a bit of a kind of cookbook. As I showed you in the Slater screen, the return on capital, very popular with Warren Buffett. If you've got any of those, Hagstrom's Buffett book or anything, he likes return on equity or return on capital employed. I would look for return on capital of greater than 12%. Some people call this the Rocky. It's also published on Stock Reports. And there are a variety of measures that we've got there. We've got a 5-year average measure as well as the green-black measure. But 12% plus is pretty good quality companies, and that's pretty useful. Look for a sustained return on capital over time that can deteriorate. Tesco had a good return on capital employed, but the return on capital was falling down before it had a tumble. I've added gross profitability because I love this metric. It's very little known by stock market investors. It's not on the stock reports, but you can screen by it. It was made famous by a guy called Robert Novi Marx. He proved that gross profitability is the most predictive quality metric. Gross profits are before, tax and interest and all that kind of thing, and before other selling and general admin costs come off it. So high gross profitability often explains why currently loss-making stocks like Ocado have quite good quality ranks. I think Ocado is on a quality rank of 77, and it's losing money. And one of the reasons it's got high gross profitability. About 25% of the market have a gross profitability of greater than 30%. And when Amazon was absolutely smashing it and it wasn't making any profits, it had a very good gross profitability. So, this is a kind of a hidden quality metric that I quite like. It might bring up loss makers, but it can be a predictor of future net profitability, which would end up in yours as a shareholder's pocket. And the other one is the F score. This is on Stock Reports. I'm just going to switch to Stock Reports to show you. The F score is one of my all-time favorite measures, and it's this wonderful widget on the Stock Reports here. You want to screen for shares that have a 6, 7, 8, or 9, it's just wonderful. Do dig into it. I'm not going to spend any more time on it because I know I'm very time conscious. But go now. My whole idea behind this screening cookbook is that you can go and set these filters up. So you could go and say, right, I'm going to do as Ed said. I'm going to try and find growing shares that are good quality and have quite good momentum. So you can go into the interface, use the F score, go F score greater than 6 or return on capital greater than 12, and use other metrics from the other slides in this cookbook and start getting used to the sort of the levels of some of these fields. Moving on to value, as I said earlier, I'm not going to spend time on this. Jim Slater's PEG ratio. Look for a PEG less than 1. That's really great if you're a slightly value-minded growth investor. So I've included it in value here. One of the best measures of value that more professional investors use is the earnings yield, popularized by Joel Greenblatt in his book, The Little Book That Beats the Market. Our earnings yield measure is the EBIT divided by the EV. I won't explain it, but you can have a little play around with it at levels of greater than 8%. You can sort of think of it as the inverse of the PE, but it's not really. Our version is a bit more complex, uses the full capital structure of the company. But this is the kind of metric that more professional private equity kind of investors would use. And so it's very powerful. Do read up on it. I've also added the PE ratio mainly because it's so popular. There's a full slide on it elsewhere in the deck. Now, to be honest, if you're a high quality, high momentum investor like Bill O'Neill in How to Make Money in Stocks, you would completely ignore the level of the PE ratio. One of the biggest lessons I ever learned was to totally ignore the PE ratio. But that's because I've learned to use, I do like investing in high quality, high momentum shares as part of my portfolios. This book, if you are someone who wants to find growth stars, you might be willing to bend the rules on the P ratio a bit more. Bill O'Neill did a study of the biggest market winners of all time, and he found they all had very high price earnings ratios. So there you go. But I've included that for the more value-minded investors there. Now, red flags. These three metrics are all on the stock reports. They are the bankruptcy risk measure, the earnings manipulation risk measure, and the F-score, which is the health trend measure I just showed you. Now, when screening for them, I'm afraid they're a bit more fiddly. So I've just used the cutoffs here for each one of those measures. Now, this is the Altman Z1 score, actually, but I won't explain that. But if you do want to cut out earnings manipulators, use that measure. I did do this late at night, and I hope I got the numbers right, because I always have to remind myself. I don't always remember the cutoff. And the wonderful thing about the stock reports is just this, that when you go on the stock report, we've standardized these measures so well. So, for example, back on Sylvania Platinum, they make up these metrics. So if there is an earnings manipulator, you can see here it will say this says this one's low. Sylvania Platinum is not at high risk of bankruptcy, and it's got a good health trend. But these are based on the Z score, the M score, which you can screen on. So this cookbook is designed to help you use and make screens based on these. So do have a dig around. Dividends. I'm getting closer to the end. Dividends. I like using the rolling forecast dividend yield. Obviously, forecasts can be wrong, but I find it helpful to know the expectations of a yield and protect myself from dividend cuts by using quality metrics. A good yield depends on inflation and interest rates, but currently the median in the market is about 3.7%. It will depend where you are in the world. So a good screen rule is to look for, I like to look for the better quality, better yielding stocks than the market. So, I mean, a good rule at the moment is about 4%. But if interest rates went up, you might be looking at, you'd expect yields to go up, and then you could change that a little bit. Dividend cover is about how many times the dividend is covered by the earnings of a stock. Once again, this is on stock reports. It's very important. We put it in the financial summary. So if you go, there's a nice dividend section here. This stock, Sylvania Platinum, is projecting a dividend of 5%, but you can see in the history, not much evidence of a historic dividend. So I'm presuming this stock has got starting to get profitable and will start paying a dividend. But the dividend cover here historically has been pretty strong in the last couple of years. The dividend's ramping up, and I like to see that that's above 2. Jim Slater would have liked to see that it was above 2 as well. So bear that in mind. It's a pretty good benchmark. If a dividend cover is less than 1, you're worried that they're going to have to pay the dividend out of their cash, and it can cause worries about a cut. I like looking at the growth streak. I just showed you on the financial summary. We have a variety of what are called streak measures, and you can search in the interface for streak, and you'll find some interesting measures. The dividend growth streak shows the number of consecutive years dividend growth there's been. I like to see at least 3 or 4 years consecutive dividend growth, ideally more. but sometimes stocks do stop their dividend and hold it at the same point. But I think that's a pretty useful metric. So this dividend slide, it shows you the yield as well as some measures which can give you more confidence in the dividend. And I'll screen in using some of this cookbook in just a minute. Growth ratios, I've already explained. I like these rolling 1-year forecast ratios. So always make sure, I personally prefer the forecast for growth, but some people don't if they don't like broker forecasts. But I like to see 10% plus growth if I'm doing a growth screen. And again, here's a streak measure, earnings per share growth streak. So this shows 3 years consecutive growth. I think Slater in his book, he actually only actually liked buying shares with at least 4 years consecutive growth. So another thing that's quite useful, bit of a hidden metric, that's kind of like inside a Stockopedia secret on these streak measures. But one thing that Bill O'Neill in his great book, he actually looks at what we call Q on Q or quarter on quarter earnings per share growth. So while most of the growth measures will be year on year, companies do report quarterly or on an interim basis through the year. So in order to find those explosive growth winners, sometimes you can find growth acceleration. And that's what Bill O'Neill in How to Make Money in Stocks always focused on. He wanted to find momentum shares that have evidence of accelerating earnings per share growth. So I can show you how to do that if I have time. But this is a particularly good measure. So if you search in the metric, in the interface, I'll show you how to do this. Going back to Stockopedia. Sorry about, I have to jump back and forth. There's no easier way of doing it. But if I go to screens and I click new screen, and I can go and search for EPS growth. There we go. Sorry, it's actually here. We've actually put it as a separate Q on Q earnings per share growth, interim earnings per share growth. This will be quarter on quarter growth. I know UK stocks often report on a 6 monthly basis, American stocks quarterly, some UK stocks quarterly. This will always look at the most available quarter on quarter growth. So, and I know I'm getting more advanced here, so hopefully some of you are still with me. But if I look at like 5% growth quarter on quarter, immediately I'm whittling it down to 311 results. So this might be like the latest interim period over the previous interim period, and that's showing you quite significant growth rates. That's quite useful. And you'll find these sorts of measures in the, if I go to the Bill O'Neill screen I like so much, you can see he's got lots of quarter on quarter, quarter on prior year quarter, and annual growth measures. And you like seeing that growth is accelerating. So he's actually looking for quarter on quarter growth higher than annual growth. So it's like a growth acceleration. And this strategy has done fantastically well. But that's one kind of sort of screening hack measure for those who really like finding accelerating companies. So if I've had a few questions I've spotted in the interface in the chats box saying, how do I find stocks that are just about to take off? That's one way to do it. No guarantees. Mark Weber's asking me, sure, on a previous slide, on the red flag slide, surely I meant F-score less than 4. No, I should have clarified on this slide that actually this is a way to avoid red flags, not find the red flag shares. So I will. I'm as I said, I did this late at night. I hope I haven't made a mistake. If I have, I will send something around. But the idea was like, this is how you exclude red flag stocks, not include them. So I tried to say F-score greater than 4 would exclude the red flag shares. So I hope that makes that clear. So there you go. Getting some questions about entry points. I'm about to come on to momentum, which is quite a good way to seek into timing. I've talked a little bit about relative strength, so I won't duplicate it. I like, as Jim Slater did, looking at relative strength greater than 0 if it's in a set of different fields with other screening metrics. But greater than 5% will give you more confidence that it is significantly beating the market. This is also something that Bill O'Neill liked to look at, and there's a lot of academic research on stocks at or near their 52-week high. So if you have a share which is has been up near its high, it may be near breaking out. Now, this is not an actual breakout measure. We are planning on including more kind of like technical screening metrics in due course. We have a big data project on at the moment, which is going to entirely replace and create a lot more power in our screening capability. But this actually finds you shares that are at or very near their 52-week high. So I like looking for shares within 10% of their high. So this actually metric is a bit odd. It shows you stocks at the discount to their 52-week high. So the metric's always negative. So I like screening for greater than minus 10%. That will find you shares at or near their high. So have a look at it. Do use it. I'm just going to have a little sip of water because I've been talking for a little while. Yes. Great. No, thanks, Steve. Glad you like the cookbook. Couple of questions on back testing. That's part of our rebuild of our data system, is so that we can provide back testing. That will be coming in due course. So won't guarantee it, but I will say it's very, very high on my agenda. With a lot of the investments in data and capabilities that we're doing, we want to provide the ability for anybody to backtest their own screens. So bear with us on that. The other nice momentum metric I've always loved using, I got this from one of my, I've read a lot of TA books, and I like the simple metrics for technical analysis. There is a metric in the screener called price versus moving average. And I like to see that the 200-day moving average price is below the current share price. So let me just show you a couple of ways of using these to find trending shares in the market. So I'm going to go to screens, new screen. Let's go and let's look for average. I'm going to use price versus moving average, 200-day moving average. Now that's, okay, there's about 225 trading days in a year, but this basically means that the price is above its average price over most of the last year, 0, right? And this will show you the percentage that it's above its 200-day moving average. If I hover over, you'll see that most of these shares will be trending up. And that's pretty cool, because that means that you've got good confidence. These shares are all trending upwards. I'll talk a little bit more about customizing your views, because the default here is a 50-day moving average. But you can see that most of these shares are above or trending upwards. And so I like that 200-day moving average screen. So it shows me shares trending up. Now, if I was to add a rule, which is like 52-week high, price versus 52-week high, add it. And as I said, minus 10. So within 10% of their 52-week high, you can see probably more confidence that they are up or at or near their highs. And this is always a good, if you create a screen like this, you can, and let's say you add, let's say StockRank, or if I was going to add, if I'm really into high quality, high momentum shares, and I would create a screen like this, and I'd go, give me shares that are higher than a 90 quality and momentum rank. And I'm going to find ones which are growing as well. So I'm going to find growth, let's say earnings per share growth, forecast rolling greater than 10%, let's say. Instantly, I know I've got shares forecast to grow that are above their 200-day moving average, within like 10% of their highs. And that's 42 results. So I save that screen, and I'm going to go, I'll call this like, breakout candidates. Okay. And I'm saving that. It's there in my sidebar for perpetuity. And these are breakout candidate shares. And if I click this little bit here, I can watch their charts. And I like seeing shares that are kind of like, maybe pop up. We're going to be improving these charts in due course. But here's JD. It's broken out. Maybe it's popped up too much. But you can see lots of these are made a little kind of like, they've made a little range here. And I'd be hoping to find them all break out. So I might look at some of these and go, these are breakout candidates, click them, and I can add them to a portfolio or a watch list quite easily. So pretty cool. So anyway, back to my slides. That's how I use these sort of screening cookbook ideas to create my own custom screens. Very powerful, powerful stuff. Now, I've only got 2 more slides to crack through here. So earnings momentum. Now, if you know the momentum rank that we use, the earnings momentum is a super field. Momentum rank is half price momentum, half earnings momentum. Earnings momentum is more subtle. It's on the stock reports, but further down in the broker section. And there's 2 fields I really like to look at. And so this one looks a little bit arcane. But search for EPS estimate upgrade, and you can use the estimate upgrade either for the coming year or the year after, fiscal year 1 or fiscal year 2, forecast year 1 or forecast year 2. And it shows you the amount the brokers have upgraded their forecast for a stock in the last 1 month or 3 months, depending on the type of field. And I like to look for stocks that have a positive earnings estimate upgrades. So that's pretty powerful field. Because it shows you, and you like to try and see if you can catch it, catch early upgrade cycles on stocks. I also like earnings surprise, which shows you shares that have surprised the market in their last earnings report. So in other words, that's stocks that have beaten their previous broker estimate. So I won't use this right now, but try using some of these metrics in the screener, and you'll find shares that are, have been beating their earnings broker forecast. So pretty powerful. Now, I'm actually starting to go a bit faint because I haven't had any lunch. So I might just have a quick, because I'm going to go into and have a quick bite of a banana, if you don't mind, just to give me some energy. Right. Last slide, liquidity, risk, and size. This metric, again, the bid-ask spread, and I think these are more to do with trading, etc., and risk. So finally, and I think this bid-ask spread measure is so important. When I first got into investing, I bought a Canadian share. This is like back, in the early 2000s, and I was still a bit inexperienced. And I bought a Canadian share, and I bought it, and I chucked my purchase at the market, and I got my trade executed at 30% above the bid, the quote. Now, one of the ways, 30% above the mid price. Now, one of the ways to try and avoid situations like this is to look for shares that trade more frequently and have more volume on either side of the bid-ask spread. So bid-ask spread is literally the difference between the buy price and the sell price that's quoted by the broker. And you can see this on stock reports. It's pretty useful to have a little quick look at it. I'll just go again to Sylvania. Again, Sylvania Platinum, I don't own it. Just seems to be the one I'm looking at today. Now you can actually view the full quote here. And you can see here's the sell price, the bid, and the ask price, the buy. And you can see a spread here, 127 basis points. That means there's when we looked at it, yes, actually in our last computation, that means a 1.27% spread. So, when you look at this screen, you can see there's about 45,000. You can buy 125,000 shares at 39p. The spread isn't too high. But way to use this when you're screening is to add rules. Let me go and show you this. My breakout candidate screen, I'm going to edit. I'm going to search for spread, bid-ask spread, add the rule, less than 500 basis points. There's 100 basis points in 1%. So that's a good way to understand it. And that's, I don't really want to spend 500, buy shares with a 5% spread. So I might bring it down, 2% spread. So, the tighter the spread, the less likely you are to get a bad execution. If you're in a big spread stock, you might want to make sure that you put in a limit order on the market. But it's an important screening rule that many don't look at. And I would always be careful looking for spreads. So it's a very useful field to screen on. The 1 year volatility, I've done some webinars on the risk ratings. The risk rating is a very good way of doing this, but also you can use 1 year volatility, which literally gives you an estimate of the previous historic volatility of the stock on an annualized basis. Microcaps can have volatility of like 100% plus. I like to look at shares with a lower volatility. Don't like it being up at 55%, although some speculative shares can give you a lot of upside. If you're a very conservative investor, look for shares at 35% or less annualized volatility. But the easy way is to use the classification of the risk ratings. It's much easier to use. You don't have to remember these limits. And obviously also in the market cap, the market capitalization, again, it's on StockReports. I like small caps, so less than 1,000 million or less than $1 billion market cap. But, the Amazons and Apples of the world have done very, very well, and they are, mega caps. So each to their own. That's all the slides in my cookbook. So I'm going to stop there. And don't slip on the banana skin. Yeah, I know. So anyway, I really hope that's useful. And what I try to do is there's so much data in there. And if you get more advanced in understanding financial data, you can make some super powerful stuff. So that's pretty cool. Now, I've done a whole bunch of other things. I wanted to share with you. Now, I'm going to go even a little bit deeper again into the types of rules you can build. And then I'm going to show you how to customize your table displays on Stockopedia. So this is only going to take me about 10 minutes or so before I'll go into like Q&A. Still lots of you on this, watching this, which I really appreciate. So let me say I've saved my breakout candidate screen, and they're all in here. There's one or two cool things that I can do. Let me just go back to my slides because I want to share with you. Oh, where are my slides? I can't believe it. I've actually turned my slides off. Stock screening webinar. Right. Let me just go to the next one. Share it with you. I've gone to the wrong screen. Bear with me. Going to go to my slides. I've only got a few minutes on this. And it doesn't seem to be working. Why not? Thumbnails. Right. Some data quirks, modifiers, streaks. I've covered some of this. Now, some people say they'll see in the interface, you've got this thing called include dual lists. Now, I just want to explain that and explain what dual listed stocks are. We exclude dual listed stocks by default. You can understand it best when you think about what a primary listing is. Most stocks will list on a stock exchange. Let's say they're a UK stock, they list on the UK stock exchange, and that's it, done. They have a primary listing there, and that is where they list. But let's say you're an Australian company and you want to access British investors. You've got your primary listing on the ASX, and you want to try and create liquidity from UK investors because the London Stock Exchange is a very big exchange. You can create a duplicate listing or a dual listing which trades independently on the London Stock Exchange. Now, there are a range of them. I'm not sure how many there are. In fact, I can find out quite quickly on the site by clicking that button. But you can include dual listings in your stock screens if you wish. They're sometimes less liquid. As I said, companies normally list their shares when they want to raise capital, and they worry less about the liquidity. So, often, but Royal Dutch Shell is actually in the FTSE 100, and it's a dual list. I often get the question, why isn't Royal Dutch Shell showing up in my stock screens? And it's because it's a dual list. So because the primary listing is in Amsterdam. So there's actually, it's a merger between a British and a Dutch oil company. So that's quite important to know. If you're looking for depository receipts in America, you might include dual list too. So important to know that. All you got to do is check that button, and it will include all those other shares. Now, there are a few hundred of them on the London Stock Exchange. There's quite a lot in America and around the world. And that's all I wanted to say, really. They're excluded because often, you might find some Russian GDRs. You might find some pretty odd stocks in there. And I think it's quite standard in screening to exclude them by default. So that's one thing to understand. Next, I don't seem to be able to... there it is. I've spoken a little bit about these modifiers. In that screening interface, often you'll see this little blue drop-down menu, which allows you to jump from historic data to forecast data or potentially other types of data. And I just want to explain a little bit more about that. I've talked about forecasts, and there's two forecast ratios that we have. The 1-year forecast, 2-year forecast ratio, which is based on the actual forecast date for every company in the market. Now, the problem with that is if a company could be reporting in 1 month or in 11 months' time, and you wouldn't necessarily be comparing like for like on a forecast basis. So I prefer the rolling 1 year ratio. I'm not going to explain how we can calculate it, but there is a slide in this deck. But it allows for more accurate like for like comparison across the market, and that's why we use it as default. So if you want to use forecast data, use the rolling forecast. Similarly, on historic ratios, we do often provide a last year field or a 1 year ago field, which is the previous year data. But I prefer, and what is most standard, is the TTM or the trailing 12-month period. You can think of it like a company may have reported in the last quarter, or even have reported 3 quarters since their last annual report. So the data can be very out of date. And someone asked me a little bit about our data process. We standardize data to try and make it best and most comparable in the market for stock screening. And so for historic data, by default, I like to use a trailing 12-month, forecast data rolling, and it just gives you much better data. So do use that where possible and where available. There are other things. There's multi-year metrics. Sometimes you'll see a 5-year average. That'll take a ratio like the P ratio and look at a 5-year average, can be useful. The compound annual growth rate, or the CAGR, it will take a field and look at how it's the annualized growth rate of that metric has happened over time. So if you see a CAGR of earnings per share, sort of EPS or anything like that, it will be the annualized growth over the last however many years. So that's pretty powerful. I talked a little bit earlier about quarter on quarter metrics, and I won't duplicate that. There's also quarter on the prior year quarter. So that might take the latest quarter or interim period and compare it with last year's similar period. So it's a bit like an annual figure, but on the most recent interim or quarter period, rather than the quarter on the most recent quarter. So they can be quite useful too. And crikes, I also was talking about streaks. So if I go into the sites and we look at streaks, you will see some quite cool data, which I'll do right now. Jump back into the interface, and let's go and just search. I'll do it on breakout candidates again. Let's search for streak, and you can see we've got consecutive years of EPS growth, at consecutive sales growth, consecutive dividend streaks, etc., etc. So I'm going to use that, add consecutive years of EPS growth, and say I want to see at least 3 years earnings per share growth. And that's whittled my little breakout candidates down to just 9 results. So that each of these will have at least 3 years consecutive earnings per share growth, which could be a good thing or a bad thing depending on what you're looking for. So streaks are quite powerful. I enjoy looking at those. Now I want to go on to the advanced rule types. So if you've been paying attention, you might see this. Add a rule, and let's go, I don't know, I'll just think up any old one, the return on capital employed. Return on capital employed. You can see here we've got this blue add rule button, which I've been clicking for this entire webinar. And I've saved some of the best till last. Add advanced rule. Click that and you'll see 4 special rule types. And these special rule types, you can use a ranking rule, an average rule or a median rule, and a comparison rule. I'll go through each one of these in turn. The ranking rule, return on capital employed, rank in market. This will default to the best direction for that field. So if there is if it's a growth figure or a profitability figure, or a price earnings ratio, where lower numbers are better, it will always say rank greater than 80, a bit like the stock ranks. The rank in the market, if it's in the top, it's always ranked out of 100. And if you look at 80 plus, that means you're looking for that field in the top 20% of the market. This is so cool because actually it means you don't have to remember what level to look for. If I want to find the most profitable shares in the market, I just go return on capital employed, rank in market in the top 20%, greater than 80. We also provide rank in sector and rank in industry group. So if you want to find the shares that are in the top 20% ranked return on capital in their sector, that's how I would do it. You see, that's right there. It's amazing. And the return on capital has been added into the table as well. So you can see these are high return on capital companies, high profitability companies, and that's how you do it. I can do the same thing and go return on capital or any metric that's a financial metric, and go add advanced rule, and I can look at an average or a median. So I can go, let's look at medians, and I go return on capital greater than, let's say, 1 times the median. So let me just delete that other one. So these will all have profitability better than the median profitability of the market. You might want to do better than that. You might go, actually, I want it to be twice the average or twice the median. And you could go, I want it to be twice the median of the sector. And these are all companies that have got like return on capital much better than the average in the sector. And that's really cool because, some companies, there are some sectors that are much more, might be more profitable than others. And this allows you to be a little bit more fine-grained in your screening. And I think that's very powerful. Now, the last one I wanted to show you is return on capital employed. You can compare it. You can compare it against another metric. So I can go return on capital employed greater than, let's say, I know this would be a pretty odd one. Actually, let me say I wanted to show what's a good one for me to. Okay, let me say I want to see free cash flow per share update greater than 1 times the earnings per share. I'm not going to explain this, but let me just show you how I do that. So I can find shares that are making more cash flow than they are actually doing as earnings per share. You can go and fiddle around with those advanced rules as you like. There are 1 or 2 good examples are actually in value investing, the Dremen screens. David Dremen has a great book on contrarian investing. If I was to copy this, make a copy, blah, 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 and I edit it, you can see there's quite a lot of advanced rules in here. In his book, he used a lot of medians, and he wanted to rank, he wanted to find like shares in the top 40% according to price to cash flow. And he's got he also likes to know that shares are better than average in terms of profit margins and averages and blah, 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 blah. So some of those advanced rules allow you to get much more fine-grained in your screening. That's super powerful. I don't know any other screeners that do allow you to do that. Certainly not in the UK. I think this is one of the most powerful screeners on the web. So very cool. It is a good feature, Mark. So that's the advanced rules. I've shown you dual list, ranking rules, medians, ratios, and I wanted to show you customizing tables. So let me go back to my breakout candidate screen, where we've got this nice, remember we did this nice little set of rules: price against the moving average, price against near the high, good quality, good momentum, growing share, good spread, and I haven't. This has actually got a range of market caps. Actually, look at that. Got some large caps in AstraZeneca and Diageo, and some tiddlers, Sysis, Ramsden Holdings. This is quite an interesting list. Now, what I can do is, and I should have actually said this a lot earlier, quite a few people have come on the site from the old site and gone, where are all my tables? Well, they're here. They're in this little drop-down menu. Now, you can there are 8 pre-rolled tables based on a whole range of ways of looking at a stock. So, quotes. This shows the last price, the change on the day, the high-low, intraday, blah, 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 the stock rank, etc. The ranks shows you all the stock ranks in one table view. Quality rank, value rank, momentum rank. Unsurprisingly, these are fast-growing companies with a high-quality, high momentum rank, so they're quite expensive. These are kind of winning shares, what I call high flyers. Stock rank style is pretty much high flyer all the way down, and you can go and look at the quality. It's all pre-rolled in the interface. Fantastic. Now, on every single stock, I'll let you go and explore those in turn. On every single stock screen, there is one thing called the screen view. And that's dedicated and based on your screen rules, but you can customize it. Click Customize, and you can see the table editor. And again, on the left, you see all those familiar categories of fields that I've been talking about. And in exactly the same way as when screening rules, you can go, oh, well, I want to see the stock rank. So you click StockRank and it will say confirm column. So I've selected it, or I've searched for it, StockRank. And again, it will find it and it will tell me to confirm the column. I'll confirm the column. And here in the right, these are all my table columns, but they're shown vertically. So if I've got a table and I was like, actually, I want to know what sector they're in, I can go into profile, I can go sector, and I can add it into my table. And I can drag these up and down as usual. So I might go, I want the market cap. Oops, what have I done? I want the market cap up there. I want their name above it. And I can save the table. Hey presto, I've got the market cap where I put it, the sectors there, stock ranks in there. I've got a really custom table view. And I might go, actually, do you know what? I don't want the spread in there because I know they're all in my range of spread. And I can save the table. And now if I go and click away, I go and look at anything else, and I come back, the default table view will be that one I've saved for that screen. But I can use any of those other. Now that one will never travel around with me to other stock screens that I've saved. But the other screens, the other table views will. So in this drop down, let's say you've got quality here. I've got a range of fields here preset across return on capital, margins, F-score, those red flags we're talking about, etc. But I can customize this. And I could go, do you know what? I don't want to have the 5-year average return on equity, so I can remove that. I really don't care about the M-score, the bankruptcy, the F-score. I just remove all these things, and I can customize it, and I can go, I just want earnings per share growth, and I can add that one in, find it in here, confirm column, and I can even change which, as I said, those modifiers. I can go, I want that forecast rolling earnings per share growth in that table view, bang, and it's right there for me. And that is really super powerful. Now, if I go to one of my other screens, I can go to this copy of Dremen, or even the one I did earlier, the growing yield in quality stocks, and I go to my quality table here, it's there, and it will always be there. Now, let's say I've messed it up, and I'm like, oh, do you know, Ed had given me this like really great table view, and I just wish I knew which was in it. I want to go back to the default. Well, click Customize, and here it says Reset to Default. Click the button, bang. It's straight back into the default table view. And you can do the same on the original screen view for that page. You can go Customize, and it will, oh no, sorry, actually that doesn't work. But anyway, because I haven't saved one there. But anyway, you can keep customizing them, you can reset them, etc., etc. Just love that. It's so powerful. These table tools are great. You can move the columns around, etc., etc. Now, as I said earlier, you can go download it, download the data, copy the data, download. I've copied to the clipboard, and if I was to go and create a new, let's say a new spreadsheet, let's say in Google Sheets or in another spreadsheet of sorts, you might prefer Excel. I can go in, download, copy the data. It's on my clipboard, so I don't know why this isn't loading. Great to see that Google's products are loading much more slowly than Stockopedia's. Makes a change anyway. I don't know why that's not loading. It's quite annoying. But anyway, I could copy that straight into Google if that was going to let me. Google's so slow. Look at that. Multi-billion-pound company completely can't, ruining my webinar. There you go. Anyway, take my word for it. You can just go into a cell and paste your results in. You can go fiddle with it in a spreadsheet as you wish. Otherwise, you can download as a CSV or an Excel, and it will download to your desktop, and you can just click that and it will load up. Brilliant. Fantastic. Of course, if you are screening, one of the most important things is how do I get it into a portfolio? Now, there's a checkbox on the left here, and all of our all of those indices all of those columns, you can check that checkbox and we'll load all of them tick all of them on the left. Going slightly mad, been talking for too long. I've been on 2 hours, so I'm gonna wrap up soon. But go add to folio, and you might want to go, I've got test one here, add it, and it will go into that portfolio, and you can view the portfolio, and all those stocks will be added immediately into that folio of your choice, which is pretty useful. So, you can be manually, if you go, let's say you've got a breakout watch list that you're screening on, because in a stock screen, all the results will change every day as we get new data. So, be aware they will change. It's a great way to, great way to go and add stocks to permanent lists. The other thing to note is, of course, you can add alerts and notes on stocks from this cog icon. And the other great thing on the table is these other two views. So you do have what I call the charts view, and it gives you, again, mini charts over multi-year timeframes. You can look at all those charts in, let's say, 3 years, 1 year, 6 years. Not sure why I've got a problem there, but anyway, lots of different ways you can quickly scan the shares like that, or look at them as bubble charts, which I won't go into the detail of, but essentially they use the stock ranks and they show you the quality rank and the value rank on a grid. And I think, to be honest, I have covered almost everything there. There's a good question there. I'm now going to go into my Q&A, because I'm pretty sure I've covered everything that I wanted to cover. It's taken 2 hours. Thank you so much. 300 of you still here. And I will do some Q&A now, as long as you guys want me to. I'm probably going to have to get some lunch at some point, but I will keep talking. One point someone's asked is, do you know where the relative... on our Guru screens, we do track the entry and exit dates of the candidates that are in the strategies, but we're not yet publishing it on the site. So pretty soon we will add the date at which each stock last qualified into this table view, and it will pop up on the right. Unfortunately, we don't have that on your personal screens, but we do have the data on our tracked Guru screens, and we'll add them at some point. Sorry, hang on there. There's comprehensive and then there's Stockopedia. Thank you very much. I will try and get that relative strength article to you. Let me try one more time. Relative strength, Ed Croft. Let me see if that loads. Let me see. I'm sure I wrote an article there. No, only an article about me having a sore backside when I went and did a cycling trip. Anyway, I'll find it and I'll see what we can do. Anyway, how to predict companies that are going to collapse and how reliable is it? Well, you can go into the Guru screens and you can go into the short selling section. And lots of these, you can see they've tended to underperform. Here's an example, James Montier's Unholy Trinity screen. These short selling screens we expect to underperform. And this shows stocks that are very expensive, got lots of bad metrics. You've got bankruptcy risk shares here, and this is an earnings manipulator screen, and these have dramatically underperformed across a lot of the world. Stocks with red flags. Of course, some of them do well, but lots of them do badly, and on average, they tend to do badly. So that's why I say that it's good to avoid them. But these short selling screens, I wouldn't say they predict what's going to collapse, but they certainly help you find ones which are at risk of it. Have another banana. I am having another bite of my banana. Anyway, short selling. I don't like, what I like to do is if I do short shares, but I don't short shares to sort of profit from them in the way that you're thinking. I will short shares to hedge my long exposure if I don't want to sell my longs. So if I've been known to run completely long short portfolios and spread betting portfolio. I've done very, very, very well in the past. I may well start it again quite soon. 1 year I actually did 75% on a long short, high stock rank, low stock rank portfolio. So literally using the screener to find high stock rank shares to go long and low stock rank shares to go short. And I bought 30 of each and I leveraged it up. And I did 75% that year. The next year, I was flat, and I've gradually unwound it. But I'm thinking about going and doing it, and I didn't lose money on it at all. And the way to think about it is, if you go into the Learn section and you go stock ranks and ratings, A good way to think about this is, like in general, we found that high stock rank shares have a tendency to outperform, low stock rank shares have a tendency to underperform. And if you go long high ranking and short low ranking, you can sort of hedge the market exposure so that if the market goes down, you're not going to go down with the market. But as long as the high ranking shares outperform the low ranking shares, you're in good shape. Now, that's great in periods where the market goes up. For example, I can show you like this. There is what you might call a spread. So there's a spread between the high ranking shares and the low ranking shares. If the market goes down, both the high ranking and the low ranking shares go down together. But you hope that the high ranking shares go down less than the low ranking shares. But there can be periods where, let's say, the low ranking shares outperform. And that can be a little bit brutal if you're caught on the wrong side of it. I'm not sure I can find one. But look, here's a little example. Low ranking shares in this sort of month dramatically outperformed the high ranking shares. So anyway, I'm not going to spend much time on it, but just some context. Can you send an alert when a stock screen enters or leaves the results of your screens? Now, we have built this. So I'm really hoping that we have... one thing you can do is you can go into the Learn section, and I'm sure you've seen it on the site, the new bit here. You'll get a little new flag, but it goes into this little bucket in what's new, and we're releasing these regular upgrades. We keep releasing increments of software. The last one wasn't on September the 11th. We're releasing probably every week, but we're trying to bunch our communications around more significant things that are being built. There is one due to come out quite soon, but you can keep track of the things we're delivering here. We have what we call a Scrum process, and we're delivering increments all the time. In the product roadmap, you can find out more about some of the features that we've got in development. So we're doing some discussion improvements. We're planning on doing more on directors' dealings. And we've got a range of improvements across chart signals, stock rank breakdowns, major institutional ownership. We are seriously considering level 2 data at the moment. And you can also see some things we've recently shipped. So that's very, very helpful. We are planning on, I can't remember what the question was now. Oh yeah, well, we actually built it, but we removed it before we actually deployed the app because we had a few bugs. But we're going to be adding the ability to favorite and then also get alerts on screens when things come in and out of it. So at some point that will come round, and I think it'll be very, very cool. And remember, you'll get these little in-app notifications up here. That's another great benefit of the new site, is you get in-app notifications, not just email notifications. Let me remind you, go to, if you aren't yet on the new site, please go to /opt-in, stockopedia.com/opt-in, and you will get all these great new features. Thanks for that, Mark. Any other questions that you've got for me? We're losing a few people, still 277. I'm happy to answer a few more questions. Maybe one thing I can talk about, which I talk a little bit about, is choosing a strategy. A good question there. Choosing a strategy, I just want to sort of dwell on this for one moment, because I do use this Venn diagram a little bit about the stock ranks, or these main 3 factors that I personally use the most. Going back to that slide earlier, you'll remember I was saying stock screening is really about filtering the market according to factors. So, you're trying to focus on, these proven factors that academic research has shown tend to help you beat the market. So quality, value, and momentum being a big part of the stock ranks. And a nice way of thinking about that is this Venn diagram where you get these intersections. And I really like thinking about these intersections according to a lot of the ways the gurus tended to sort of frame their investing. So actually, funnily enough, Neil Woodford's in here, who's had a pretty bad time. But let's admit he was a very good investor until he made some bad decisions recently. But he lost his discipline, basically. Neil Woodford lost his discipline, and as a result of losing his discipline, he's had a bad couple of years. But the best investors in contrarian investing tend to be people like Warren Buffett, Joel Greenblatt, Joseph Piotrowski. They all like buying quality merchandise when it's on sale. So I call that quality value investing, or QV investing. They often don't like using momentum because either they don't believe in it or because they're big investors and they can't profit from it. Personally, I think small investors, you're really leaving something on the table if you don't use momentum. But I know a lot of people are uncomfortable with it. Now, if you look at quality and momentum, which is written out in books like this, Bill O'Neill's How to Make Money in Stocks, Mark Minervini, Trade Like a Stock Market Wizard in his books, they focus on high quality, high momentum shares. They like trading with the trend. He's got this guy, Minervini, he basically talks a lot about the cheap trap. Don't know if you can see this, but Minervini, he's very, very adamant about it. And he talks about the cheap trap. Really good book, by the way, Trade Like a Stock Market Wizard by Mark Minervini. And it's like, don't pass on high PE stocks. And it's again and again, you find that, analysts, who are paid in the city, they don't understand what really drives stocks. They don't understand factors. And often they will get nervous on shares that have high PE ratios. But in books like these two, you're going to learn how high QM stocks that have other factors driving them, breaking out good momentum, powerful quality and growth, can dramatically beat the market. I like calling it the strategy QM, and it's what I would say value agnostic. So it excludes PE ratios and that kind of thing. And a good quote here is, it seldom pays to invest in laggards, look for market leaders. Bill O'Neill bought himself a seat on the New York Stock Exchange purely from his analysis of and literally buying breakout stocks. There's a massive literature on it. So that's there. And on the other side is where I think the quants live. It's quite an unusual area, and frankly, this is ignoring quality, ignoring profitability, only using value and momentum. I showed you earlier that VM, value and momentum rank, high VM rank shares have beaten all the other ranks in terms of a 25 stock portfolio since we started in inception. And I wrote, if you actually go on the site and you search for value and momentum everywhere, you'll find a great a blog I wrote about, a great paper by Moskowitz, who basically showed that value and momentum are the two really most powerful anomalies in finance, and investing according to them in every asset class, in currencies, in funds, in bonds, in stocks, it works. And I know that these are the sort of, in combination, they are actually the two most powerful metrics. But a lot of the quants design these strategies on value and momentum and ignore quality completely. And you'll find turnaround stocks in this mix. You will find some high quality shares that have value and momentum, but you'll also find sort of turnaround shares which are don't have good current quality measures. But momentum is a leading indicator of future quality. So James O'Shaughnessy tested all his strategies in what works in Wall Street, and he found that trending value was the best performing strategy since 1963. You can see how much my thinking on investing, and I've done so much reading, and this really is my holistic map of understanding a framework for all the different types of strategies that the famous stock market investors have used, and putting them in a framework that the StockRank helps comprehend. Bang in the middle there, you'll find some more mixed strategies like Robbie Burns, who I would say he looks for more kind of blended, high quality, high value, high momentum shares. Similarly, Jim Slater has some of those different metrics. The overall StockRank does that itself. So what I like to say is that depending on who you are, you might be someone who doesn't like value, finds bargain stocks rubbish. You might be someone who really wants to find growth shares, and you might want to go hardcore growth in terms of high QM. and trade actively. But it's all about finding an investment style that fits your psychology. If you're a dividend investor, you might want to focus just on high quality shares with good income. So you might be just very much over in this part of the metric. You're more, or even in the middle, because yield is kind of a value metric anyway. So dividend investors would be much more in this kind of bucket. But you can apply the yield across all of these sorts of areas. So I think that's a great framework for understanding and developing discipline in your investing. I think that most people get a bit scatty, a bit willy-nilly about their approach. And I'm not encouraging anyone to just choose one approach. But I think, getting really good at a style of investing, it takes effort, takes time, takes discipline. And you won't do it just, as a pastime. It's something that takes years to develop. Okay, I'm going to look at some more questions. Well, great question. I did want to cover this. Why is the growth rank ignored so much? Great question. So in the Stockopedia interface, you will find the growth rank, and you can screen on, but it's not part of the StockRank. It's not part of QVM. Now, I'll tell you why. Firstly, the academics, as you'll see in my factor profiles in this QVM Venn diagram, but also the great research that the academics have done into what pays off and why. And you'll notice it's not in this factor, this sort of factor framework. And the reason is that growth tends to be mean reverting. And that means that companies that have grown quickly recently, if you just use growth on its own as a metric, they will tend to mean revert, and that growth won't continue. It doesn't mean growth is not useful in combination with other factors, but on its own, it doesn't work. And that's been proven time and time again. And actually, if you go and look at the growth rank in our tracking, I think it is available in the StockRank backtester, you'll find that it hasn't done nearly as well as the quality rank, and value rank, or the momentum rank. Now, the other thing is, in my analysis, in the early prototyping of the StockRank, we found that the growth rank basically was highly correlated with the quality and momentum rank. So the shares found by momentum and by quality were similar to the shares that were found by the growth rank. So there was a sort of correlation there. And we found that if we removed the growth rank from our framework, it worked much better. And it was more predictive. It also predicted future growth better, and so on and so forth. So we've left the growth rank in there and all the individual growth metrics. And I encourage you to use them depending on, if you are a growth investor, but use them as factors in combination with the other ones. And I think that's a very important thing to understand. Yes, Barry, I did say that the performance of the charts in Stockopedia Screens is based on the top 25 of each of those screens. So if I was to go back into the app and go to browse and the screen tracking, it does depend on the screen actually, because some of them we've overridden. So I'm pretty sure the Greenblatt magic formula includes the top 30, but every other screen, and that's explained up here, but every other screen it's 25. But actually, just also to be a bit more clear, and this is actually available in our help notes, we also apply some liquidity constraints on, so it's the top 25 also according to some added liquidity constraints. So for example, in things like the deep bargain investing screens, they can be full of some pretty horrid little companies, and we strip some of them out to try and make it a more liquid set of stocks. So it's not just the top 25, there are some liquidity rules too, and that's worth bearing in mind. Is the QVGM rank useful? Well, you can use the QVGM rank. You can actually go in here, go to the performance history, look at the QVGM rank, and you'll see that it's done okay. It's done pretty well. The 90 to 100 rank shares have doubled since 2013, but the QVM rank shares, or the StockRank shares, have done 140%. So removing growth from the overall stock rank has accelerated the performance of those top ranked shares. If I show you the growth rank on its own, oh blast, it's not in the interface. Well, that's unhelpful. I'll see if we can get it added in. But anyway, growth has not done as well. So that's one reason. Yes, we will provide a video download. I will provide a video download of this in due course. It's all been recorded on YouTube. I'm conscious it's been nearly 2.5 hours, and knowing I probably should get some lunch. Happy to answer a last couple of questions if anyone's got them. When would I sell a stock according to momentum? Oh, no. I've got one other thing before that. I'm going to go to my webinar slides from a couple of weeks ago. It's all about stock reports. And I'm pretty sure it's looking at the wrong one. Hang on a minute. Window, stock. Let me just close that. Okay, you can't see it at all now. Let me try again. Stock report webinar. Okay. I'm just going to go and find I wanted to talk about data quality because that's really important. Our data process. So I was asked about our data process and the quality of data. And I just wanted, before I go, to explain this to you because I think it's important to have confidence. Thank you, Paul. Really appreciate the compliment. I am trying to do more again. I'm going to try and do one every couple of weeks for a little while anyway. It takes a lot of prep, but they're pretty productive. So the data process, we use Refinitiv, which is spun off from Thomson Reuters, who gather. They have thousands of analysts, a lot in Asia and in the UK, who scan, in fact, all over the world, scanning and auditing and standardize financial data entry into their databases, which they upload to their financial cloud. That's really important to understand, and we do receive it pretty quickly. Throughout the day and night, we download raw data from them to our own servers, which we host in the cloud, financial statements, analyst estimates, price quotes, other company information into our database, which is nicely shown here. We then have our own data filtering and cleaning up process, and we crunch about 60 million computations every day. We build up a library of more than 2,000 essential, accurate, timely statistics on every stock. So that's where all the P ratios and the F scores and all come from, which then becomes the Stockopedia product, and that creates the ranks, the stock reports, and the screening database. So the database is updated once a day, and of course we create all those different variations of the data, which you see too. I believe it's one of the most accurate databases in the UK. We are working on improving timeliness all the time, and we're working on improving accuracy all the time. As I said, you can't, and even James O'Shaughnessy says, you can't always have perfectly clean data. I think our data is the cleanest in the business. O'Shaughnessy did actually an interview on a podcast when he was asked about the error rate in data. And there is a small error rate. There's always a potential that some data points might be wrong, either because a company has changed its annual year end, there's been an error from the company, an error from the input analyst, there's been an error on our side, which is unusual. But it's a very small percent of the data, but it does and can happen. And really, what I always like to say is you've got to have comfort in the error rate. We do have thousands of investors who care about the data, using it every day. So we find out about them with our own pre-publishing process, as well as if something does sneak through, because all our subscribers are so data hungry, we pick up on it very, very, very quickly, and we get it sorted out. We go back up the chain and we find out where the issue was, and we are amongst the top 5 reporters of data issues back to Refinitiv, which I think has been bought by the London Stock Exchange. Thank you very much, guys. Some nice compliments. But we go back to Refinitiv and we will get them to update the data. And if you talk, I answered last year 20% of support requests. I'm not doing as many this year, but often you'll talk to Sonia, who's level 2 CFA candidate. She's also got a master's in finance. You might talk to Tom or Ollie, who are both CFAs. Alex, who's a CFA level 1. Lots of our people who I've been really clear about, like trying to make our support staff who are not full-time support analysts. They are working on the product. They're working on investment data. They're working on their domain specialists that I've picked up from and try to hire from wealth management firms because we're quite an ambitious company. So they are all really, really well-educated, bright people who love stock markets, and they figure out exactly where the data comes from, and we go and track it back and we sort it all out. So anyway, we have what I believe is some of the most accurate data on the web. So, and tell us where we can do better, because I'm always trying. How do you view previous webinars? Well, I love you've asked that question. At the moment, Sam, I know you're listening. We need to get the previous webinar on YouTube. So the previous webinar is on YouTube, but it's hidden. That's the stock report webinar for 2 weeks ago. We'll get this one up and running as soon as we can. And basically at the moment, there's no link in the app, but if you go to YouTube, you can search for Stockopedia, and you really should look there. I'm hoping that this will show you. Blast, hang on a minute. Let me just try this. If I go to YouTube, right, you can find Stockopedia, YouTube slash Stockopedia. I'm pretty sure that's going to come up. As I said, Google's products are really slow today. Stockopedia is absolutely fizzing, and Google can't help us. There we go. Can't load a spreadsheet. Can't load Google. What do? It may be because I don't know why, but anyway, you can go on Stockopedia. Sorry, that's not for some reason loading. Search for Stockopedia, and there it is. Got a few thousand subscribers, and you can go and look on playlists. Webinars. At the moment, they're old ones. That's a StockRanks webinar from last year. But in the next couple of days, we'll get both of these webinars up, and they'll be in there. There's lots of other useful webinars and videos on a whole range of different topics too. Trying to invest in video all the time because it's quite popular. We will get them in the app. It's just that we've got a bit of a development backlog, and that's it. So anyway, 2.5 hours, marathon session, 236 heroes still on the call, and heroines, I'm sure. Thank you all so much. I'd love it if you do. We might send around a survey and ask what we didn't cover, or what else you'd like to learn about. I'm hoping to do webinars on very specific topics in future. So I might do like a webinar very specifically on, especially more educational investing topics. I'll go and have a nice lunch. It is 3:30. Finish the banana first. And I really, yes, we'll send through the deck. It will be available to watch again. And I really hope you get lots out of it. Brilliant. And really go and enjoy the stock screener. It is superb. And I'm really proud of the new one. The devs on it have done such a fantastic job. And it's only going to get better. We've got a whole range of upgrades, scheduled. And I'm so excited about where the product's going. I mean, I know that some of you coming over from the old site, there's a lot of new material on the new site, but there's a few things which are still to come over, but you're missing out on some of the really cool goodies. So opt in, come and have a look. You can always go back, and if you're really, really a stickler for the old site, there's a few things we're going to improve to make it a little bit more, some features more like the old site. But anyway, just really come and enjoy it and check it out. Thank you very much, guys. Really appreciate it. We'll send out the slides very soon. And all the best. I hope you got the I hope you got the slides on the crib sheet, the cookbook. But anyway, speak to you all soon. See you on the site. All the best. Bye.